Hey guys and girls, welcome to this Wednesday webinar. Really exciting to have everyone on board, and we have an all-star team line up for you guys to ask your questions through. So today I'm going to introduce you through to the team. I'll get everyone to give a bit of a background on their position. Obviously, always say no financial advice or anything on that, but today maybe we can say some of those things because we do have some experts here. So if you can just all let me know that you can hear me, tech is okay, you can see 6 of us on your screen, just flick us a little message in the question box, that would be awesome. Cool, Brett can hear us, everyone else can hear us, awesome. Cool, any questions that you've got, just flick them through to that question box throughout the night. I will ask the questions to the team and get them to answer the questions for you. So this is a bit different. Going to be hosting it and having a panel of people to answer the questions. I think there's a couple of questions for me. I said I don't want to see them. I want to answer them at their most, rawest and answer that I will be able to give you from, your questions. So we'll get straight into it. But before I do, going over to a slide, I will introduce you to the panel of experts here. So we've got Stephen Sidorovski, who is from Zenith Legal. He's the director of Zenith Legal. Steve, just gives a bit of a high five for everyone.
Hey.
I think it has his name on the bottom. And maybe a little blurb, I don't know, something about yourselves as we go around. So Steve, maybe just something about what you do and all that. Zenith.
Yeah, so for those of you who don't know me, my name's Steve. I'm the Solicitor Director at Zenith Legal. We do mainly property law, so I've probably helped you guys out with your conveyancing transaction. I've been doing this now for about 14 years, and yeah, essentially we're sort of here to go through all the legal stuff, all the paperwork, make sure everything's in order before you guys get locked into a contract. And yeah, we've been dealing with Nath for a number of years now, and helping sort of service his clients and helping them achieve their property goals.
It's been over 10 years we've been working. It's probably like 12 years or something now, Steve. Like
it has, yeah. It's probably been about 12 years.
12 years. There we go. You've done hundreds of property transactions for myself, and you're probably one of the most highest volume lawyers that are out there when it comes to the property space. There's not a lot of lawyers that that you can trust to build large portfolios, and there's lots of moving parts. And I think when someone's buying a property, you got your finance, you got pest and building, you got clauses, you got special things that can be hidden to tie people's legs together, or let them free. And the one thing I've really noticed over the last 12 years of working with you, Steve, is that I've never lost deposits myself personally. None of our clients lose deposits, where you do a very your eye for detail, and the job that you do is very good. So thanks, Steve, on that front. So next up is Ridhwan from One Path Accountants, which is the director and senior tax advisor at One Path Accountants. Rid, just a little bit about yourself.
Hey everyone, we probably met on a couple of webinars with Nathan over the years, budgets and whatnot. Similar to Steve, it's coming up to a decade that we've worked with Nathan. So I've been doing this for a while as well, helping clients with all things matter of tax. So personal, company, trusts, property related. So we do a lot of tax. We have a couple of offices, one around the corner from Nathan's and one closer to the city, to help a few people out that way. So yeah, we've done and seen pretty much everything. That's one of those things where we're always looking forward to helping clients get on their journey and complete their journey in some instances.
Yeah, and a lot of ill advice out there, like when it comes to building a large portfolio, the structuring, the things that I've seen over the years from lots of accountants, just poor structuring that costs people a lot at the rear end. And the thousands of investors that we've worked with that all have 6, 10, 15, 20 properties in their portfolios. It's not by chance that people just get there. It's important to have the right people to be able to get there. So yeah, thanks for that. We've got Chris from Blink Property. Thanks, Chris, for joining us. This is probably the first webinar we've done.
It is, Nathan. It's the first time I've been live with you guys, so it's great.
Yeah. So have you ever done a video like a live or a webinar before, Chris, or is this the first one in history for you? Or?
First live one, yes, yeah, for sure.
Yeah. Awesome.
You'll look after me, I know you will.
I'll be nice, mate. I'll be nice. Everyone will be nice. With Chris looks after the New South Wales, team at Blink Property, making sure you're getting the most rent through properties, and we're getting the highest return. And it's important. I actually did a live last night with Andrew from the team on Facebook, and looking at the results and going back through. There's lots of real estate agents out there. People can have properties, they can give them to the local real estate agent. But the reason why I started Blink was seeing that you have pro-landlord real estate agents and pro-tenant real estate agents. And, obviously there's a mix that the tenant's the consumer at the other side, but we need to make sure that we're helping the owners reach their goals. And a lot of the stuff that, we specialize in at Blink is really understanding the goals of the owners of the properties, because most real estate agents look after people with 1 or 2 properties in their portfolio. We're looking after investors with 5, 10, 15, 20 properties in their portfolio. So couple of words from you, Chris.
Yeah, I guess we service investors, whereas real estate agents have property management portfolios so they can sell their properties, basically. Easy access to them. We don't have that arm. We're not pushing that arm. If people want to sell properties, we can certainly put you in the right direction. But our emphasis is on long-term growth and trying to help every investor just increase their portfolio.
And I guess it ties really well with finance as well, because every $50 in extra rent that you get for an investor, that goes to help financing the next property and building out that portfolio. And I was talking to someone today actually, and I hadn't spoken to him for about 18 months, 24 months, and they sold 2 of their properties, and I cringed, and I said, how much did you sell them for? And they told me a price, and I was like, why did you sell them? And the property wasn't with Blink. And the agent said, it's a good time to sell the property. And they made some money, but they left 150 and about another 100 on the table. A couple of $100,000 isn't good to leave on the table. And I think when we look at people's property portfolios, we call ourselves asset managers. We're property managers managing people's properties, but we're treating it more like a fund rather than hey, yeah, here's your property, we'll hold it, you should sell it, we'll get a commission, that sort of stuff. So Chris and the team, it's taken me a very long time to get this business to where it is today at Blink, and Chris and the team really, the knowledge and the care that goes into making sure everyone's portfolio is performing is imperative. So thanks, Chris.
Thanks,
Rose. I just said I've known Steve for like 20 years. Known Ridhwan for 10 years, 11 years, however long it's been. How long have we known each other for, Rose?
Oh, you were only a young lad.
I still am.
Age of 18.
Sorry?
Wearing this pink t-shirt with a necktie and that sort of thing.
I used to wear, people will think you're lying, Rose. I used to wear cufflinks and a tie with a tie, pink tie. And I was 18 years old. It's like 20 years ago that I met you, Rose. 18 years, something like that. It's crazy.
Yeah, and I always remember you now. Like you came to me and said, "I want to get retrenched from my company. I don't know. I do anything and everything to get retrenched." And then they made a compromise. Okay, we'll give you you get retrenched, but you have to work certain out up to certain period. We'll give you the pay slip, and even if you were not working, you've been getting these pay slips.
Yeah, I realized that my job wasn't going to help me anymore with my portfolio, and I was like, I'm ready to take a redundancy. And Rose has known me for almost 20 years, and without having the funding, I wouldn't be able to have my portfolio that I could share today with everyone that I talk about so often. So thank you, Rose. How long have you been in finance for and doing what you're doing?
I have been probably 20 years, at least 20 years.
Yeah.
In
So
2001, I think 2001, 21 years, yeah.
there was no such thing as a mortgage broker back then. You were like one of the first.
There was like few of us, and it was not regulated, unregulated, right? But that was a good time when I joined to become a mortgage broker. You can just be a mortgage broker anytime at that time. But then again, they to make sure you have the cert for the diploma, and it was good. It is good then, because now it's regulated and we don't have any cowboys in the mortgage broking industry.
And Rose, just before I get get to the questions, there's something you love telling everyone. Rose is very humble, and Rose is one of how many platinum brokers?
So I can't hear you, Nai.
Out of how you're very humble and you like to be modest, but you like telling everyone about your platinum brokers. How many platinum brokers are there in the country? And
there's only 70 in the whole wide world of Australia. 70 mortgage platinum brokers. I'm the number 70. And there's some more. There's some more, Nai. In the magazine this week, I didn't realize Impei rang me last week and said, "What is your take on inflation?" And I go, "Oh my God, you asked me that question. I'll have 2 hours to tell you." And then I didn't realize I was quoted on that MPA magazine issue. That was only last week.
Yeah.
And there's
so
another
Rose,
more.
We may not have Rose for too much longer. Hollywood will want to take her soon because she's very.
I need to have plastic surgery to be in Hollywood, right?
No. Well, thank you, Rose. I'll get on to Gemma. Gemma, tell us a bit about your background.
Oh God, so I'm obviously from England, and I went traveling and landed here with you, and my entire world completely changed from start to finish. So yeah, my background now is I'm in investor relations, and I'm kind of listening to all you talk is really it's actually really good to see connect the dots. The investor relations teams kind of connect everyone together, and I have the privilege of using every single person on this screen, and yeah, so we get to see it firsthand what each expert does and how they make a difference to the clients.
Awesome. And you're an investor yourself. You came here with no properties. You're killing it with your property portfolio now.
Yeah, no, I came here broke. And yeah, you've kind of made miracles happen, and yeah, doing it myself, which is terrifying but exciting, and you've got the support here, and you know, I'm dragging everyone along for the ride. Poor Stephen had to read my 600-page contract a couple of weeks ago, so thank you, Stephen. But yeah, doing it myself, and yeah, just seeing it all firsthand, really, it's really good.
Awesome. So I guess your journey in the business, you're working with the investors from the investor relation team. You know, what's an investor relation manager? Customer service team, helping people with their journey. There's lots of moving parts. It's not every day someone's building a portfolio of 5, 10, 15, 20, 30 properties in their portfolio. Some people come to you with 10 and they're stuck. Some people come to you with none and they want to get started. And you have access to the whole team and being able to put the people into the right hands. And then, you know, so I know you've got a client that came on board last week that you spoke to 2 years ago, did nothing, but now is ready and is going to kick ass with the goals. So, yeah.
Yes. And it's actually really humbling when they call you like 2 years later going, "Hi, I'm back and I did everything you told me to do, now I'm ready." It's really good that people actually listen. And a lot of the time it is, you know, we might send them to Rose, come back, okay, now you need Ridhwan, okay, come back, now you need to go speak to Chris. And it's a real machine of yeah, just getting people in a good position. Yeah, when they call back to say they actually took the advice and did it, and now I think they're buying 3 now. Which is, yeah, it's really good to see. It's really good that they remember to call back.
Yeah. Awesome. Cool. Well, let's get into the questions, guys. I'll try and keep them very sharp and very short. This one is the first question for Stephen. How young were you when you first set up your will? Which I don't know if that meant the question to me, or if it's more of a question for Stephen. So how young should someone be when they start up a will? Like if someone's 20 years old, they may not have a property, they may have a first property, might have a couple of properties. When's too young, or when is young to set up a will?
Okay, so the minimum age is obviously 18. You have to be an adult to have a legal will. And essentially, everyone should have a will, but specifically anyone that has any assets in their name should have a will. So as soon as you have an asset, whether that be a car or a bank account with money in your bank or an investment property, you need to have a will.
Yeah. And even if you didn't have a will, I've just got a random question for you, Steve. Let's say someone's a tenant, right? Like Chris has heaps of tenants and that he manages and whatnot. And the tenant might be like, I don't have a house to rent. I only rent a house. I don't own a house. I might own a car or whatever. What happens if someone passes, right, and they have their super fund insurance? Where does that go? If someone has children but no assets, like, can you write things into the will that say, okay, my children get taken care of from this person, the family, or that? Can you do stuff like that? Just random question.
Yeah, so it's not limited to your assets. So, for example, in your will, you can put your wishes as to who you'd want to be legal guardian of any minor children that you have. That's obviously subject to any checks by the authorities. So it would just be what your wishes are. As far as your super, generally with your superannuation, if you have an industry, if you're with an industry super fund, you would nominate with that fund who your beneficiaries of your super are. Alternatively, if you have an SMSF, that would be incorporated in your SMSF deed. And likewise, life insurance, if you have life insurance, it would be whoever the beneficiary you've nominated in that policy is. But everything else would be covered under your will.
Perfect. I guess it gives you the opportunity to work from the other side of the grave, morbid as that sounds. And, everyone, I think wills are very underrated, especially from the amount of people that we see on a daily basis. The amount of people, like, I think everybody watching this and everybody on the video would have insurance on their car. What's the car? You smash your car, it's 20 grand, right? It's 50 grand, it's 30 grand, 100 grand, whatever your car is. That's the cost of it plus whatever your damage you do. But people will spend the money, thousands, tens of thousands a year insuring things. But when it comes to insuring their life's work and making sure that money goes into the right place and the people, that you care about, if something was to go wrong, would benefit from it, you might be dead and go, hey, it doesn't bother me, but your life work, you should have it insured, and for a small amount of whatever it costs for a will, it's cheaper than a car premium for the year. And I think everyone should be looking at that and taking that serious.
Yeah, absolutely. Yep.
Thanks, Steve. I've got a question here for Rose. For a new business, how long must you be trading for before lenders will grant you a loan based on your business earnings?
Well, you can borrow with 1 day ABN, but ideally, look, 1 day ABN, we can do it, but obviously limited to a second tier type of lender like Liberty, for example. But ideally, in a perfect world, 2 years of being a self-employed, 2 years or 18 months. Now, there is also a possibility of just 12 months, one day, all that kind of things. But 2 years ABN is more ideal because then you have you can borrow. I mean, all the main lenders, the second tier would require 2 years at least, some of them. So yeah, 1 day ABN, you can do it from PAYG also to a self-employed, as long the transition period from PAYG end of June 2022 will be the basis of the income. Yeah. Because as long as you're in the same industry, so it can be done 1 day ABN.
Yeah. So most people think they have to wait 2 years. Some banks like ANZ will take 1 year. Is that right?
No, ANZ will take. You have to be self-employed for 18 months. However, the documents that are required can be just single financial, could be just 12 months.
12 months. Okay, cool. And anywhere down to
Sorry.
Can I ask a quick question?
Yeah.
So, Rose, is it 2 years of registration from the date of the ABN, or is it 2 years of trade?
It should be, ABN must be at least 2 years of registration, and normally it should be trading at least 2 years.
Perfect. Thank you.
Some people can get away like, oh, the ABN was registered for 2 years, they haven't been trading until just the last 12 months. Now, the bank, say for example, ANZ can take a singular financial, so we may take the last 12 months of that financials.
Perfect. Thank you.
But there are some.
I guess on that front.
Yeah. With self-employed, there are other alternative way of providing income documents like ANZ and CBA. You can do pay slips if you are self-employed, paying yourself for the last 6 months, say for example 150,000, as long as you're able to demonstrate that for the last 6 months, provided the accountant can say you're trading profitably. CBA would require an accountant letter that says you're trading profitably and there's no debts for the company, whatever it is that is required by the accountant. You can show the pay slips. ANZ doesn't even need an accountant, it just need the pay slips for the last 3 months or 6 months at least. There is a salary credit. So there's a lot of alternative now for self-employed.
I guess that comes down just with Ridhwan's question. If someone's thinking or planning of, I speak to people on a daily basis that are like, I want to become self-employed, or I'm going to be self-employed in the future. I think that if you're planning or you're thinking of it or your intent, it should be something you should be planning today. If it's in 2 years' time, you could start with your ABN, you could start with your proprietary limited company to get some history behind that. You might do 1 day a week work, or you might have a commission that goes into that. You can start trading as that ABN today.
But to also remember, Nathan, the lender sometimes would require 2 years of trading financials, or 2 year of financials. Now, if you're the first 12 months, you're only doing part-time of that business, then they will take the average between those 2 years. So it will pull down if, for example, the first year you're only earning 30,000 and suddenly you get 150,000, they'll take the average between the two if there is a 20% margin, or otherwise to pick up the lower of the 2 years. So that needs to be also considered, right? Doesn't mean because your ABN is registered for 2 years that you can just get away of having a business on the second year. You have to remember, some banks would require 2 years, some bank would require 12 months, but in reality, the bank would expect you to be trading for 2 years, even if they require only one financials.
Okay, fantastic. Thank you, guys. Next question here is for me. What do you think about investing in commercial property and co-living property? Which one will provide a good cash flow? That is a good question. There's so many variables that are missing there, right? So many variables. The questions that I would be asking would be surrounding that would be, what is the end goal of what you're trying to achieve? What is your financing like? What is your servicing like? What is your deposit like? When you buy a property that's a commercial property, Rose, how much deposit do you need for a commercial property?
Well, if it is a specialized security like motel or a daycare center, they might require 65% LVR. That means you have to provide 35% of deposit. But as a general rule, I think 25% deposit if it is a commercial, it is like a warehouse, an office, or that sort of stuff.
Yeah.
But specialized security, as I said, motels and daycare center, they may require more than 35%, like around 35% deposit.
So when factoring it in, like, what do I think about investing into commercial or co-living? I sit there and think, okay, if I need a 20% deposit and I can buy $1 million worth of residential real estate, and I need a 40% deposit and I can buy 500,000 worth of real estate, I need to question, what is the bigger picture and how is the property going to fit into my strategy? Commercial property, people rave on about it, saying you get a 7% or a 10% or an 8% net yield or whatever the case may be. You can buy a $150,000 property like one we did today, the rents are $300 a week, you get a 10% yield. You could put down a 20% deposit. Even if you want to go 90% lend, you could put down a $15,000 deposit. So I wouldn't just, I think there's a lot of people out there in the market that are selling a specific strategy because they only want to sell commercial properties, or they want to sell their course that gives you co-living or commercial properties. And you need to look at it and go, okay, that's okay, but how does that fit in the overall strategy? You know, what are the options? But I've sort of doodled around with different sorts of scenarios. I always workshop my ideas before I take action and I start going on a wild shopping spree. Steve will probably laugh there because he's always juggling my shopping sprees that I go on at the property and on the lawyer. But you know, I always look at and try and work out, if I go down this road, how far can I get close to my goal? If I go down this road, where can I get to with my goals as well? And you know, it's a very broad question about asking, what do I think about investing in them? I own lots of motels, obviously, nowadays. I've got lots of residential properties. I've got lots of commercial properties as well. And they all have their place, but it's at what point in your portfolio, or what point in your strategy is it worthwhile doing that, and is it effective to be making that switch? Because otherwise, you need to look at and consider the risk level in your portfolio. Yeah, you need to look at the risk that you'll be bringing to the table by taking out one of those properties. So, Rose,
No, yeah, can I add on that as well? If you are purchasing a commercial property, right, now to refinance or to harvest the equity in that commercial property, you can only buy a commercial asset, right? Or because you cannot use the commercial equity to purchase a residential property. I have one client there that has a lot of commercial, the equity on the commercial, but he can only harvest that equity if the purpose of that equity release is for commercial. So it's different with residential. You can harvest the equity on residential to purchase a commercial, but not the other way around. This is something to do with the NCCP, which is the non-coded or the credit protection thing. So,
very
so that's
important.
that is the disadvantage of buying a commercial property, because you can only use the equity for commercial purpose.
And each
But
time
another question. Sorry.
Each time you get a loan on a commercial property, you have to pay a valuation fee. I've got an invoice for one today for $11,000 for the valuation for that. They're not cheap. It's not just like going to, you know, Combank or CP or Westpac or whoever and just saying, hey, give me a residential loan. They value your property, you know, willy-nilly. They charge big exorbitant valuation fees.
Also the application fee as well. Application fee could be like a 1% of the loan amount.
Yeah, and when you go to value the property, there's not much to compare it to. So with a residential property, you can see that there's 50 properties sold last month in the suburb. With a commercial property, it's like, okay, one of these sold in 2016 or 2018 or whatever. There's much more limited market, so it's not liquid, which is why the bank requires a larger deposit. Ridhwan, you had a question or something to say?
Yeah, so it's because recently you've done a few blocks of units. Are they always considered commercial deals, Rose?
If over 4 multiple dwellings, more than 4, it's considered commercial. Now there are only a few lenders that can cater for 4 in one title. Now once it hits over 4 in general, it's considered commercial, even if they're residential in nature. This is what we have a dilemma with ANZ Bank, for example, right? They might be residential in nature and yet deemed to be commercial. With ANZ, I would say, okay, if this is deemed commercial, I'll put it to commercial lending. They will not accept it because it is a residential security. So in effect, ANZ doesn't entertain multiple dwelling for a residential security for over four dwellings in one title. Hence, we go for maybe second tier Liberty. They do that as a commercial.
So it depends on how many units are on the block. Are they strata titled in the block? Some banks will lend more.
Strata title is not really a multiple dwelling, Nathan. It's a multiple dwelling in terms of some in just one title. Strata title, you can just borrow as per
Yeah.
strata titled unit. Yeah.
I have a question. I've actually spoke to a couple of clients that have commercial properties in their super. What is anyone's thought on, or Rose, your thought on putting a commercial property into a super? If the fund for the deposit is there and the cash flow is there, is there anything they need to be careful of?
Before we do anything on that, we can't give super advice here, just everyone. We're not giving super advice or financial advice. There's a little disclaimer, but yes.
I think Ridhwan should be able to help me with this answer. So commercial self-managed superannuation loan is deemed commercial, right? The bank would consider it's commercial, no compliance required. But the commercial is just the same as residential lending when it comes to self-managed super fund, except that the deposit required is probably higher or lower LVR compared to a RAISY loan. Is that right? Ridhwan, you know that, right?
Yeah, so look, I mean, obviously, as Rose mentioned there, the self-managed super fund space is compressed when it comes to lending, so the big four banks don't do it. There is a little bit of bylaws and the way in which the lending part of it is written up by the smaller tier banks. So you do have some constraints there, and obviously the big one, it's a good question, Gemma, is the amount of capital that you're going to inject into that one property is probably going to be close to 40 or maybe even 50%, depending on the postcode. Is that correct, Rose?
Yeah, correct. So with the commercial lending as well under self-managed super fund, there's on any self-managed super fund lenders, there is only La Trobe, Liberty, First Mac. First Mac is good at the moment with 5.69 interest rate, right? Compared to La Trobe at 8.70, and then you get Liberty. If you're high end net worth of SMSF, you can get a rate of 6.09, but you have to have at least 700,000 in the self-managed super fund. And then there's also the ratio that you need to retain in your super fund. Liberty would require 10% retention of you can't use all your super fund. First Mac doesn't have that condition. So yeah, liquidity ratio. So if you have a 200,000 balance in your self-managed super fund, you need to retain 20,000 at least. So liquidity ratio is required for Liberty. La Trobe doesn't have, First Mac doesn't have, but you just have to be careful with some lenders. You have one lender like La Trobe, for example, you have to have, if you have a self-managed super fund with them, you have to stay with them for 5 years, only because there is a condition there that if you leave within 5 years, there is a exit fee of a lot. It could be 10,000 exit fee. So as a good broker, you need to find out all these things before you can even lodge this application, because at the moment you get 8%, you get 5.96 with First Mac. How are you gonna refinance the loan from La Trobe when you get an exit fee of 10,000 or 15,000 for that matter? So it's very important for brokers to know who are these lenders and because they're deemed commercial, they can do the exit fee. Same as when you borrow a commercial property not under SMSF, there's always that exit fee. So you have also First Mac. Paperwork for First Mac is a lot compared to Liberty, yet they've got the best rate. Liberty is easy.
I guess, Rose, the important thing is to make sure that your finance strategy is in line with your acquisition strategy. So if there's lots of content there, I've got lots of questions, so I'm going to move to the next one as well. Thanks, Rose, for your in-depth, and I'll just come and reach out to Zinger for more questions like in detail. Question for Chris. Question here is, does Blink Property offer on-demand portal access to see the rental income statements?
Yeah, good question. Our software recognises the importance of the client's ability to look at their statements as necessary. They can see what rent is coming in, they can see what accounts are being loaded to pay. So yeah, short answer is they have full access to an online portal.
Yeah, awesome. I got a random question. It's not a question here, but it's just a question that someone asked recently. There's two parts to it. One's a question I know the answer to. Yeah, well, both of them I do. The question would be, how often can you put up, or is there a limit on how high you can put your rent up?
No, there's no limit on how high you can make the increase as long as it is not exceeding current market value. So if you're well below, which the majority of clients are at the moment because of the COVID freeze, markets have started to move. You can put the rents up to current, so you can be 100, 80, 70, whatever it's going to be.
Beautiful. And a question that I think a lot of people don't understand is if someone was to bring their property over to Blink, for example, and get Blink to manage it so they could get the extra $100, $80, $70 a week, what would be the process? Because I see a lot of people that I speak to go, oh, I'll visit that once the tenant moves out. And I think a lot of people think that your property needs to be vacant in order for you to be able to change real estate agent or that. What's the process?
Yeah, the process is to reach out to Blink, and we help you determine the pathway forward. So if you're wanting to bring your property across, your existing management agreement with your property manager will have a termination period in there. Generally, it's around 30 days, some are 60. I have seen some at 90 days, and we can negotiate that process for you. While the property is tenanted, it's the easiest time to come across, actually. You just give notice on the change. We organise to pick up the file. We talk to the tenant, we get them on board, pay the right account, and it's done and dusted.
Yeah,
pretty easy.
And then we work on reviewing the rent, making sure everything's up to date.
Yeah, we'll go and do an inspection on the property so that we're aware of what it is and the potential it has. And if it's on a periodic agreement and there has been no rent increase in the last 12 months, definitely we can put that up. And as soon as the fixed end tenancy comes up, yeah, we can negotiate that with a rental increase as well.
Fantastic, fantastic. And I think sometimes people get scared having to call the agent and then go and pick up the file themselves and stuff like that. So basically, the process would be they sign an authority to get you to act on their behalf in the Blink team, and then from that we engage with the agent and we do all the hard conversations, and the client doesn't have to call them and go, and get sold a real estate agent trying to sell them, why are you leaving us, all that sort of stuff.
No, not at all. We pick up the keys, we pick up the physical file, we do the whole job for you.
Awesome, awesome. Thank you, Chris.
No worries.
Yeah, I'll keep some of my questions for later because I'm sure there might be some of them answered here. This one here's, as I said, I'm going to put this one, a natural sort of thing here. It says here, what is the best deal that I have gotten or purchased this year? So I guess what is the best deal? I do lots of deals on a daily basis. Sometimes people come to me and say, Nathan, you put up a $20,000 block of land the other day. You put up a shop for $20,000, or a block of units for $500,000. Where is that? I guess there's all different types of properties. Whether it be something you need for cash flow, something you need for equity, something you need, for growth, depending on what your capacity is and where you are on your journey. I think, if I broke down all the deals that I buy, some I buy that are 50 grand, some I buy that are 150 to 250, some I buy that are $1 million. Some of them have got, multiple rental income streams. So it really just depends on what it is. I do all the deals personally myself. So all the deals that I buy on behalf of myself and for my investors, I do those deals, I locate them, I get the pricing right on them. Once we've got them secured, my team put together a cash flow sheet, a lot of data input into it, see the total cash flow after all expenses and whatnot. I then put together a big, email letter as to why I like it, put in any links of why the property's got good growth and all that sort of stuff, and I send them out. I do all the portfolio construction for my investors that I work with. I've got so many deals in my head. I might handball this one over to Gemma and put Gemma on the spot as well. If you could think of maybe like half a dozen deals that come to mind that I've done in the last, month or 6 months or 12 months that could be cool.
Yeah, I think just on the back of what you were saying though, so many people are sat waiting for the unicorn deal or something that they can write home about and they're really excited by it. But also those really good deals could be unlocking 50k that you need for your next one. It is definitely, people need to look at the bigger picture as well. It's not just about, and don't get me wrong, there is some really good deals that we do. And they're incredible. And I still need to pinch myself sometimes that it's happened. But at the same time, not every deal in your portfolio is going to be a unicorn and be absolutely incredible. Some of them, personally, I look at them and I'm ashamed by them, but they're great for what I need, you know. So, but there is some really good deals. We had a Sydney deal for 285. I think the owner paid 340 for, or no, a different owner in the same block paid 340 in March, I do believe. But this particular one we bought for, well, we bought for 285, and in 2012 it was 270 in Sydney. So just showing the different kinds of growth that we do. We obviously had the block of 5 shops that I think we sold all of them for the 120, I do believe.
Because 2020, I put the post up last 2 weeks ago on my Facebook and Instagram.
Absolutely.
I just put it out there, and I put up $20,000 per property. I didn't realise that one of the properties was a leasehold, but the other 5 are, so it works out to be $24,000 per property. 24 grand, you know, that's the price of a car, a second-hand car today. One of them was rented for 15 grand a year. They should all rent for 15 grand each. So, you know, they come cheap. There's all different things. Any others that you got there, Gemma?
But sorry, just on the back of that one, that wasn't a great deal for everybody either. I think some people will see those numbers and be like, yes, we should all just buy one because it's cheap. Sometimes those deals, they are really good, but not best for everybody. CBD deal, we bought for 295. I think the previous owner paid 402, and all the comparables were at like 350, something like that. I was actually thinking before about a CBD-ish, the Parramatta area. We bought for 310, and it was only 2 weeks. I was reflecting on it. 2 weeks that we pulled out about 68,000. Well, Zinger pulled out 68,000. Thank you very much. We had obviously blocks. 800,000 for 10 units that we did. I think that was last year. Just a really good deal. I think the cash flow on that was around 120 passive. God, Queensland, we bought a duplex for 220. I think that rents for how much? I think you know which one I'm talking about. The duplex that was, I think it rents for 560.
I know it is. You've got a property located near it. Is it the one?
Yes.
Yes.
I can't remember the rent on it.
I think it's like $400 a week rent previously, and now it's about 560 on it. So yeah.
But yeah, that was bought I think for 220. So the cash flow there. You're good at doing the yields. I'm not as good as you, but
there's another one that I was just thinking of as well. I just constantly, like, that's all I do all day, every day. Now, and I know that I was chatting to Ridhwan the other day about some investors that we bought for in the Gold Coast, right? And it's funny when people say, what is the best deal that I've bought, right? We have people that we bought, like, just to put it in perspective, you haven't been looking at the Gold Coast. Like, I've been buying the Gold Coast for 10 years, and I was buying, how many do you reckon would do a month, Steve? Like 50 a month?
Yeah, it was crazy at one stage there. It was like really hot. 50
deals a month in the Gold Coast, Brisbane, right? 7 years active, really active in there. Started buying there about 10 years ago. The pricing of those properties, 200 grand, they're now 600 grand. I remember I was chatting with Ridhwan the other day about it, and some clients would buy a property and they'd be like, yeah, I bought it for 250, I pulled out 30 grand equity, it hasn't done anything for 2 years. They sell it and now it's worth 600,000-700,000, and it's like, you didn't see the longer game and how that property fits in the portfolio to get you to the end game. We've got investors that we've been in, really good communication with over the last, 2 years, 5 years, 10 years. And, they're now at positions where they're like, okay, we've identified that property. We never knew at the start when we bought 10 or 15 of them. which one was going to take off and go first. That one there has done great. We can't see any further growth to it. This one here has done great. We can't see any further growth to it. And they're now taking those properties and offloading them and then replacing them with higher income properties to get them to the next level of their journey. So it's, you know, the vehicle that you need at that stage on your journey to get yourself to the next level, which I think is very important.
I think it's important as well to utilize everyone within within the B.Invested group, so to speak, because we're here to guide even after the initial purchase. I don't think people realize that everyone on this screen can help you with moving forward, whether it's, you know, maybe you just think the rent can't go up or it's not, it's under rented. Speak to your property manager, speak to a different property manager, check with Ridhwan, hey, is this actually still viable for me? If not, hey, let's speak to Nathan, let's get everything reviewed. It's definitely not just a transaction. You need to kind of keep revisiting the portfolio. Yes, it's kind of set and forget, but you still have to be quite active in checking that it's still working. And if it's not, every year we give you a portfolio review. So at worst, it may be 6 months, it may stay stagnant, and we can offload it if we absolutely need to.
I think that's really important what Gemma said, right? So everyone's looking for the unicorn deal, but you've got to, and Nathan and I have spoken about this, you've got to love the one that you're with, right? So that's both in life and in property, in my opinion, right? So if you're all saying, oh, I've got this property in Woodridge and it's, you know, doesn't look good, doesn't feel good, etc., etc. I've had stacks of clients who have come to me who eat on Nathan. No, I'm just joking. Who see other property advisors, right? And that's all good. You know, we work with everyone. We're sort of agnostic in that way. And I'm not joking with you. More than, you know, tens and tens of occasions where they say these properties are all rubbish. They haven't done anything. They're exactly what Nathan said. Gone up 30 grand. You took the equity out. You bought another couple. Hasn't done anything. We think you should sell all the properties, take whatever's on the table, reinvest it. And so I think it's really important to understand that the best deal isn't a singular property. No one has ever retired off a singular property in our experience. Again, Nathan provides the advice on which property has come to him, is sharing all the hallmarks of why he would purchase a property himself, and then also why he's imparting that to the community, right? So I think if you think this property is the one to change my life circumstance, retirement, financial independence circumstance, then I think it's kind of like going into the diet saying week 1, I'm going to lose 38 kilos. Week 2, I'm going to hit the catwalk. It doesn't really work that way, right? You have to put in the time and you have to go through the ups and downs. And there's plenty of videos that Nathan's done. There's plenty of times, Nathan, I'm sure you can, share with us that you've gone, man, this is all too much. I've got to cut back, scale back, for example, but then you get back up in the morning and you do it all again, right? So I think it's really important that the best deal that you can get from Nathan is the one that helps you to get to the point that you want to, right? And not the particular property.
Thanks, Rid. Next question here is for Ridhwan. Do you offer a health check tax assessment service to check current structure and provide best practice and advice? Question asked by Andrew.
Yeah, look, we don't offer this as a service like you might go into a bank and they say, we'll do a finance check for you, go into a doctor, we'll do a health check for you. Generally, clients who come across to us, we have a chat for any client who comes across new that the IR team put across to us. We don't provide any specific advice in that initial meeting, but if clients want to engage, they like the sound of what we have to say, our experience, our affiliation, my own personal experience with hundreds, if not thousands, of property investors over the last 10 years. When we do your returns, when we actually get to the point where we can have a chat about how your portfolio is performing from a tax point of view, we do that. I personally do for clients who want it, portfolio reviews, not from a good, bad, buy or sell perspective, but from a tax and a structure point of view. So basically, if a property is positively geared, is it? We need to know that information. And if you've got 10 properties, are they all positively geared, or are some masking the others, or some of them carrying other ones which are not performing well? And I always tell clients, I'm very candid with Nathan, if there's a property that he's purchased and it's not working the way the client has anticipated or expects, that could be an expectation management point of view. It might not be Nathan's fault, or it could be it's not a good property, or it hasn't performed the way that Nathan even expected. And he's always open enough to say, okay, well, let's see what we're going to do here. As part of that, organically, we do that check for you. So clients, Nathan and I have talked about this ad nauseum. Clients come to us with, wanting to do trusts. Some clients come in, fully loaded, to be honest with you, with trusts, and some clients come fully armed with information about how good trusts are. And there's good and bad for everything. So in terms of how the structuring advice and best practice, quote unquote, we give you our best advice with reference to our experience, our knowledge, current tax legislation, current land tax interactions with you and your trusts and whatnot, to determine whether or not you could be overweight or underweight with regard to certain things. Like some people are extremely overweight with cash flow positive properties, right? And so they're all scrambling for equity. Having those properties in a trust is great because you can dictate that income to where you need it to go. But if you've got properties which are negatively geared inside of a trust, they might not be helping you from property acquisition point of view or a financing point of view. So yeah, we organically do that. Often clients want to sort of part use our advice. They might have another accountant doing their business and another type of work. That's not our preference because it becomes conflicting. But we certainly do sort of give second opinions and whatnot. And we're pretty honest. We're not going to sit there and take $400 an hour just to have a look at your portfolio. When we can deliver service and value, we're happy to then pass that on to you. But yeah, look, a lot of accountants and stuff will get in there and say, yeah, this is all wrong. That's not how I operate. If it's good and you're doing really well, we're not in the business of divorcing people from their accountants and advisors. We want clients to go ahead and get to where they want to as quickly as possible, as fast as they need to, rather than saying, we are, the ones that can solve all your problems. We certainly do and deal with a lot of clients and help them get to where they want to go. But it's not about saying everyone else is terrible, we're the best. It's if the advice is right and appropriate for you, then that's really important for us as well.
Thank you, Rid. Thank you. Next question here is from Adele. What are B.Invested property strategies and methodologies? And then also as a follow-up, which is here, I can see that B.Invested, I'll get Gemma to answer this. Is this one you want to answer, Gemma?
Sure, yes.
So what is B.Invested's property strategies and methodologies from your side when you speak to clients on a daily basis?
Yeah, it's good. Strategies, definitely, we've always preached the same three. Below market value, cash flow, and good yield, I suppose, which actually needs to be differentiated. People think that a good cash flow deal has to be bringing me $100 a week in my back pocket, which is simply not the case. We're always having to plead to the bank for more money, so we need to get the yields and also good upside for growth. And recently, obviously, with all of the cost of building going up, we're getting a lot of things that you can't even build them for this price anymore. So in terms of strategies, it's those three attributes, and not every property has all three. It definitely will be one of the three, and some of them might be a balance, but your portfolio definitely needs to have a sequence of all three. And I suppose that's where we would come in, is that sequence. Everyone can buy a cheap property, but we would sequence it correctly to get you to your end goal, to avoid getting stuck at 3 or 4. Methodologies, I'll be very honest, we don't use that word very often in the office, so I'm not really sure what to respond to that. Maybe I can handball it back to you.
Good. Thanks, Gemma. When I'm thinking of the question, I'm thinking about, there's people out there that want to buy one property, right? We don't have people come in, and we're not a business. There's lots of people out there. When I first started B.Invested, and Rose and Steve and Rid will remember this, there was no such thing as a buyer's agent out there. There was no such thing as a buyer's agent. And now everybody's an expert. They're a property guru. They have no assets. They can give you advice. They can go take a course for $3,000. They become a buyer's agent. They can, there's courses on how to be a buyer's agent now. So it's kind of funny. We don't sit out there and go, okay, you tell me what you want. Okay, I'll get you that house on the high side of the street and all that sort of stuff. When I hear about buying a property, the property is a vehicle to get you to your end goal. So I guess when you look at the methodology of what we look at, what is different with how we view things is that I'm looking at the property holistically of how is it going to get me to the end goal and what is it going to provide for me? Is it equity? Is it cash flow? Is it growth? Is it a mixture of all of those things? I'm not looking at, okay, let's buy this house so we can subdivide it, take the backyard off, it'll take us a year, then we can build another house on it, which will take us another year, because it's going to slow you down. I would look at that strategy and then overlay it with a different strategy and then overlay it with a different strategy. And yesterday I spoke to a guy and I actually spoke to him and he's like, if I want to push forward, I've got he had 3 properties. Someone advised me to buy these houses, put granny flats on them, all this sort of stuff. I was like, why would you put a granny flat? He goes, I know, but I just went from this trusted advice that I had. And the properties, I sent him a few properties today and he wants to take those properties. And those properties are cheaper than the granny flats that he was looking at putting on his backyard of the properties. And there's these people out there that are trying to sell you granny flats and sell you all these types of strategies. You need to have a property strategy that's going to get you to your goal. So when I look at, someone that comes on board, I'm not thinking, they're always the first question is like, what is your goal? We just lost Ridhwan there for some reason. I don't know where he's gone off to on the screen, but I'm sure he'll be back. But I'm looking at how does the property help you get to the end goal of where you're trying to be at. And the property is only a vehicle in its capacity to get you to the end destination. I also have an extra part of the question here from Adele. It says, I can see that B.Invested is not a member of PIPA, which is the Property Investors Association or something. And B.Invested as to know why you are not a member of that before I engage your services. So I'm a member of REI, which is like the Real Estate Institute. But looking at the other associations, I can pay and get little pinstripes and badges on my shirt and say, oh, we're the greatest. We've got an association over here. But let me tell you, B.Invested's been around a lot longer before any of these associations, these industry bodies. They're paid for badges that you can add onto your shirt. So, I don't see us. I can instantly go and do that. But why do we need to do that from that perspective? So it's a good question. And some people go and put it, and you may feel more comfortable using someone that has that. But it's really just a paid for logo, and you pay a few $100s or a few $1,000s a year to display that logo onto your business. They might give you some forms or something like that. But we're around a long time before the so-called industry sort of bodies that are out there. So just.
I thought you'd finished, sorry. You mentioned something before about people wanting to subdivide, or the way I was hearing that, there is a lot of people that they want to almost get too involved in the property. Sometimes you have to just leave it to do what it needs to do, but there's also people that don't get involved enough. So I have people that would come and say that they want to buy something and do a complete reno on it before I'm going to fly up to Queensland. I'm going to do a complete reno, then I'm going to rent it out, get an extra $20 or whatever it is. We have to kind of pull them back a bit and let the property do what it needs to do without getting too involved. But on the other side, I have people that are saying, I don't want to put a single penny into it out of my own pocket. And it's almost like I have to tell them, investing's probably not for you, because days like today with interest rates and things like that, you might have to plug a gap. But we can, I suppose, we kind of give the idea of in between, getting too involved, but you're also not taking your hands completely off it. And that, I would say, in terms of methodology, is getting that balance. Can be quite difficult, but obviously what we can all help with.
Can I just quickly jump in there? I think it's really important what both you and Gemma have just said, but I think what's extremely important, especially for people listening, is that strategies and methodologies tend to dictate that the formula that is required to get to the end goal is somewhat mysterious, right? Where I don't think, Nathan, correct me if I'm wrong, you've always been quite open with what said on how people should get to where they need to go in terms of financial independence and retirement, right? You've all said buy, hold, buy bread and butter, buy, all the properties that you've mentioned. And anytime we've seen, and it's not something that necessarily we look out for either, is that anytime one of these type of buyers agents or buy and builds and strategy guys go belly up and take a lot of people with them, it's always on the promise of, you know, come and attend our, what's it called, our courses and special seminars, and we'll teach you. And, you know, there's these, you know, trade secrets of how you could pay your home off in 4.5 days, and then the rest of it that you see on YouTube and everything like that. And that for me indicates that that strategy and methodology is one which doesn't necessarily have you involved in the journey. You are handing over all the keys and all your capital and all your wealth for someone to invest to be able to get these miraculous returns. Whereas Nathan, and it's not to big note you because we're here, but it's to say it's pretty straight up and down, in my opinion. You know, and you've been buying it, as you said, for 10, 15, 20 years. Properties where you bought it is no secret, etc. So I think strategies and methodologies tend to dictate there is a secret sauce with regard to it, but potentially it's just about, you know, somebody said really good, I was at an award presentation the other day, it's really easy to start something, it's really hard to go the distance, and that's including a property journey. It's really easy to buy three properties, but to get 12 and do that over 8 years, 9 years, 10 years, or 20 over 10 years, that's the tough part.
And there's a difference between buying a property and having a portfolio of properties and keeping it, because we actually had a discussion recently of people that have become successful in property that we know of, and they've become successful. They've got 5, 10, 15, 20, 30, 40, 50 properties, and they don't know how to hold on to it because they disconnected themselves. They started in lobster or whatever, and, you know, things get blurred. And it's like, hang on a second, they start selling down or taking out the portfolio there.
As you said, it's hard for some people to recognize how they got there. But when they do get there, it's a little bit overwhelming, right?
Yeah.
Just to vouch for that, it's very overwhelming sometimes. Many a phone call to Nathan from people like myself. Like, I'm literally in the business and doing it. So I'm probably, you know, out of all my clients, I'm on both sides of the spectrum. And I fully understand what we're doing here, make no mistake. But even on a tough day, and it's like, Nathan, I need to sell everything, get it out of my life. I don't want to deal with it, because it can be stressful. Like, it's not, and I think, Ridhwan, you've dealt with this before. Stephen, you've probably dealt with me as well at some point when I'm stressing out. Even if you do understand it, like, it is still.
It's super important, Gemma. Like, you cannot underestimate that emotional cycle that you go through as a property investor when 4 hot water systems break in 1 month, and you've got to pay $6,500, and insurance is not paying you out, and, you know, there's there's a notification that there's scaffolding that's got to be erected because your balcony has got 4 bits of blue metal in it that need to be repaired. That the stoicism, ability to be able to continue on, I think, is good. But if you have to have all these secret sauce methodology, strategy, scenarios, and if those things happen, it'd be really tough, right, in my opinion.
Yeah. Awesome. Thanks, team. I've got a question for Rose. Is servicing calculated on your interest-only repayments, or are they calculated on predicted repayments of principal and interest?
Servicing is always based on the principal and interest repayments. So, for example, we set the loan at a 30-year term, and if the loan is interest only for 5 years, that means they will amortize, servicing-wise, they'll amortize the loan for 25 years. So it's harder to get at servicing if the interest-only portion is longer. So when we do the servicing to fit in, to make sure it services, we'll reduce the interest period portion to maybe instead from 5 years to 3 years, so that we can amortize the P&I repayments based on 27 years rather than 25 years. The shorter the term remaining after you take out the interest period is higher. So we look at like the interest period as minimize the impact of it, because otherwise servicing can be an issue. So it is based on the principal and interest repayments. So the way it is calculated, the actual interest, we do negotiate for interest rate. For example, standard variable is, say, let's be realistic, it's 7.94 or 8.14 minus 3.06, which is the discount that we get. Then you put another 3% on top of that as the stress rate. The stress rate becomes 3% plus the actual rate. Now, when you do that, then you look at also the principal repayments based on that stress rate. We call it stress rate because that's the benchmark in calculating the servicing.
Thank you, Rose. Next question that I've got, I can see that there's lots of questions that are, there's 2 in a row here for Rose. So for a property purchase using a self-managed super fund, are your clients refinancing to other banks for better rates every few years, or is it mainly set and forget?
I think very, very seldom that you'll see that a self-managed super fund is refinanced. Unless, of course, La Trobe is 809, you go to First Max 6.59, but you also have to consider the setup costs. There's the valuation fee, the application fee, and all those sort of thing. And then if you have, especially for First Mac, for example, where an individual is obviously the guarantor of the self-managed super fund, you need to see a lawyer or a solicitor. It costs you another $1,000 to really review the documents and make sure the solicitor explain it to the individual what, as a guarantor to the self-managed super fund. Is that right, Stephen? As a guarantor, it needs to have that legal advice. So
let's not say how much Stephen charges, because I don't even know what Stephen would charge for something like that. So is it $1,000, Steve?
At least.
Well, it depends what it is. For a consultation, we charge 400 plus GST. So if it can be done in a 1-hour consult, that's what we charge. And then they come in and we do the advice and we witness it and sign the certificates, and then off they go.
There was a client of ours complaining because, I have to see a solicitor and it cost me $1,000 just to explain what I'm exposed to being a guarantor of this self-managed super fund.
They didn't come to Steve.
Yeah.
I'll charge them 1,000 plus if they want.
You need to contact Steve. It's important of having the right team on your side. So I guess, it is possible. I've seen people, and it's something I only realized like maybe a year ago, that actually people refinance their self-managed super fund loans. I didn't me not knowing that that's actually a thing. But it is a very different product just for everyone out there. It's a very different product when you get into your self-managed super fund, because it's not just like a normal property. When you get a self-managed super fund loan, it's a non-recourse loan, and there's a lot of extra cushioning around it, and it's treated very differently. So it's important you get the right advice, and I think that you need the advice from Rose, you need the advice from Steve, and you need the advice from Ridhwan when it comes to getting stuff sorted in a super fund, because there's lots of moving parts in it and you really don't want to mess it up.
And you cannot harvest equity anyway with self-managed super fund. It's purely you refinance for better interest rate, not because you want to access the equity. You can't use it.
Yeah. Awesome. Thank you, team. Next question here is for Stephen. How to protect yourself and your assets in a relationship breakup?
What is yours is mine, Stephen?
That's pretty much it. Look, if you can, essentially, if you can get in before you get into a relationship and enter like a binding financial agreement, you can enter these type of agreements at any stage of the relationship, so before, during, and after. And it's basically like an agreement to say that we agree that this is going to be the split between the assets. And then both parties sign, and like I said, it can be done at any stage of the relationship. However, obviously, if it's done before you enter a relationship, it's you've probably got the parties that are sort of on a more even playing field, rather than after the breakdown where you've got emotions involved, and then there's probably a lot more negotiating that needs to take place.
So do you have a document that someone could take out on their Tinder date with them this weekend, Steve, that they can just take?
Sure.
Hey, Chicky babe, check out this before we go on a second date?
Well, if you're in a de facto relationship, I don't think you're going to get one of those from a Tinder date after one date. But essentially, you need to be living with the person, you need to be in a relationship, and that's when you'd want to enter these type of agreements.
So, Steve, can I ask a question? If you have that, agreement, do you have to register that agreement, or it's just?
You don't need to register the agreement. It's basically an agreement between the parties, and if and when that date comes that relationship breaks down, you use that agreement as evidence in court if it goes to court, or if it doesn't go to court, you use that agreement to divide the assets as per the agreement.
If you really want to step it up, you could videotape them saying, "Hi, I am Nathan Birch and I agree that, so then you've got it in video that it's not that they're under duress, and that you could also, I don't know how that would stand up in court though, that's just like for more of a giggle, but there's all different ways that you can protect yourself. I always have random ideas, and I always push the boundaries. Like when I call Steve up and I ask him a question about something, it always ends up with a giggle, right? Steve always goes, "Oh, I guess, Nathan, yeah." When I see it from that perspective, that if the other party would agree with something, then that would be fair. And you know, it doesn't necessarily come down to a relationship perspective, but all different dealings that you do. And I think, you know, it's important to look at every aspect. One of the things I was looking at recently, which isn't to do with relationship, it's just to do with, in general, there's different things that you could slap onto your assets, right? I thought, imagine if I put a lease, if Ridhwan, for example, leased out one of my assets for $1 for 30 years, then that asset would be worthless to any other party apart from Ridhwan, actually. So there's different things that I believe could be installed, but you know, that's not something for Stephen to sit there and go and talk to you guys about. It's more of something that, you know, if I was out at the pub chatting to one of you guys on the phone on a strategy session, that I'd be like, oh, imagine if this happened, and then if you decided to go and do that, then you know, Steve could enact those sort of things. But it's important that you do, you know, just before you take advice off someone, just before you go and start out on a journey with buying properties, just before you start using B.Invested, you should always think about the people that you're involving in your life, your friends, your circle of people that you're hanging out with. If you're hanging out with people that are, I don't know, doing drugs and stuff like that, you've got to question, okay, where they're going to end up in 10 years' time and how can I fit into that life? If you're going to spend a life or a time with someone that's, you know, that you're going to be living with or be in a relationship with in that instance, then you know, you need to be questioning yourself as well when you're going into the relationship. You know, is this the right thing as well? Like, that's just something I think is very common sense, but people quite often get their emotions ahead of them. So, yeah. Not trying to give a relationship advice to anyone watching today. Any other pointers, Steve?
Let me remind you your early relationship, Nathan.
Steve, any other ones?
So I've had like where you have, you know, the parents that are trying to help the kids out in the current market, like things are pretty expensive. They want to help them out either financially to get into the property market, or essentially they're trying to help their kids get ahead. But what they're scared of, or what they're cautious of, is if I give my kids money for a deposit, or if you know, if they're buying a property with their girlfriend or their boyfriend and they're going to be on title, or even their spouse, how can I, you know, protect my investment as far as the money that I'm going to lend them or give them? And one way that we sort of we can do it is if it's a loan. So for example, if mum and dad are giving you a loan for your purchase of property, we do a loan agreement, and then we can even do a caveat or a mortgage and put it on title of the property. So if something goes wrong down the track and mum and dad have lent you this money, and then, you know, you've got this property with your boyfriend or your girlfriend or your partner, mum and dad would need to be paid out first before that property gets sold and the assets split.
Is there a limit of how many first, second, third, fourth, fifth mortgages that could be slapped on a property?
No, it obviously goes order of priority. So whichever one's on there first gets the priority, and then depending on, you know, whatever, if there's any funds left over after all those are paid out in priority, then that gets split between the parties.
So if someone was buying a property for say 500 grand and they had a 400 grand loan, but they owed their parents 100, they owned their sibling 100 each, they owed their friend, their neighbour, their other relative, their friend's business, whatever, 100 grand each, technically someone could have $1 million worth of loan and the property's only worth, some people might miss out at the end, but it would have to go in order, the first, the second, the third, the fourth, the fifth person. If someone's trying to sue you, well, then they would technically just be wasting their money, tens of thousands, hundreds of thousands of dollars, depending on the size, by suing and trying to get through all those barriers. And you've got 5 layers of protection because those people all want their money before the person wants to come in later, I guess. Would that be Fair?
Yeah, that's right. I mean, when you're talking mortgages, though, you probably need to get consent from the first mortgagee to put a second mortgage on. But as far as caveats go, like if you wanted to put a caveat on title of a property, they can, as long as you have a caveatable interest, we call it, they basically go on, and yeah, they're in order of priority. So if there's nothing left over, and the first mortgagee and the second mortgagee and the first caveator are paid out, and there's nothing left, well, then there's nothing left.
Yeah, it's interesting, that one. And I guess the other thing as well is if you're buying it under a trust, then you've got the PPSR register. Is that what it is? That thing we always find fun to overcome when
the Personal Property Security Register.
Yeah, so no one can really do something unless you have to go in line at the back of it. Is that right?
So that's in relation to other assets. So it's for personal property. So you might have like equipment or other assets that can't particularly be registered. You register your interest against that party and all the personal property they own, and you register it on the PPSR. And then essentially, that's like almost like doing a credit check on somebody. You do a PPSR search and see, okay, this person's got all these assets, non-property assets. However, these other parties have interest in those assets. So if you're like buying a business and someone did a search and they found out that all these, equipment and machinery that you have at the business, there's someone that's got an interest in it, well, they'd want that released before they go ahead and deal with you.
Yeah. Awesome. I don't give legal advice or anything like that, but I know that a lot of people in the community have questions about this stuff, and everybody's position is different. I think Steve is very important to go and talk to about this. As I said, Steve's my personal lawyer for 12 years, maybe even 13 years. It's so long, Steve. I never had grey hair beforehand, but a lot of it now.
Neither of us did.
Neither of us did. Also, the
I've known
hairdresser.
you as much as I've known Nathan.
You've known Steve a long time as well, yeah.
Yeah, same, because we used to be with the other company.
Mm-hmm.
Yeah, back when Steve, before Zenith. And
Yeah.
looking at, like if someone has a position, I can't give you that legal advice, but always here to chat to my investors that I work with to make sure that they're protected. I go above and beyond making sure people are protected. So if someone is really concerned about something like that, maybe I can have a bit of a chat on a one-on-one level about where your position is at, and then give some pointers of questions to go to Steve and have a chat with Stephen about, and see, so what to go to Steve and ask him for to protect yourself as well, but not trying to give any legal advice there, just here to, as a friend down at the pub, having a chat with, all of us to, have general conversation. But lots of ways to protect yourself, and I think it's very two-dimensional out there. People, in the system just look two-dimensional, but there's many different layers of up and down that you can do to protect yourself along the way. And it's very important. A lot of people, I think that 99% of people out there that are doing stuff don't spend that time looking, okay, how am I going to protect myself? They get too involved with someone. They might put a girlfriend they've had for 6 months on all the titles of all their properties. They break up in another 12 months and they have to buy them out, and they may not service, so they have to sell off properties. It's very important the strategy's right on that front. So
I think less even complicated than that is like family members, brothers, sisters, mums, dads, everyone's lives change, and we all see, I'm sure Rose and Stephen sees, is that that can really anchor you down in some instances. It feels good for the first couple of years, and then it becomes a bit of a problem later on.
So, thanks, team. Next one here is a question for Chris. General suggestions and lease period agreements when it comes to renting out your property. There's an extra part of this just to expand on. It says here, don't offer more than 12 months. Do I offer 12 months, 24 months, 6-month leases? Special offers that are made for good long-term tenants who don't cause problems to the property, renting property to a family. I think renting property to a family, I'll just jump on that one. I think that's a really big bad thing that I've seen that hasn't turned out well. over the years. But what sort of general suggestions could you give people, Chris, on your experience of leasing and the term of the lease? And, you know, do you look after a good long-term tenant and give them $200 a week instead of $300 a week? What's good and what's not?
Yeah, thanks, Nathan. I guess what we're seeing at the moment is the government's playing a bigger role in trying to legislate to be on the tenant side. Now, we've had legislation passed last year which said that if your lease is periodic, which means it's month by month, you cannot be subjected to more than one rent increase in that 12-month period. So what's our strategy there? We reached out to the REI, New South Wales, to find out what the effect of that was on fixed term leases, how that compared. Their answer to that was that there's a bill in front of Parliament at this point. It's on its second reading, petitioned by the Greens to apply the rules of a periodic lease to a fixed term lease. So the reason there is, if you have a tenant in situation, they are on a 6-month lease, you cannot then increase that rent if you put them on another 6-month lease. Okay, so we're still within that 12-month period. It'll only be seen as one rent increase. That bill hasn't passed yet. So our recommendation to our owners at the moment is to enter into a 6-month agreement on any property that's going out there at the moment, unless their cash flow warrants a 12-month. We've got a better chance of getting an increase for them after 6 months, which everyone wants at the moment, especially with the rates still continuing to move. The detrimental effects of that is you lose security knowing that you've got the same tenant for 12 months or even longer, 18 or 24. The cost of changing that tenant over is you've got a letting fee, you've got advertising, you've got time on the market without anyone in your property if it has to have maintenance completed with it, or if there is a multitude of properties out there in the same suburb and it may take longer to rent. So you've got to weigh up the factors of, is it better for me to have a long-term tenant at a slightly reduced market value because we value that tenant and we don't want those changeover costs? Or do you want to look for market rate and take that gamble of getting more increase in rent each negotiation of the lease? You mentioned there before, if you had a tenant in paying $200 and the market rent was $300, we believe that we're not doing any favours to the tenant in that market, because when the time comes for them to actually move out or are forced out for whatever reason, they're adversely affected because then they're subjected to higher rents in the market all the time. So we always believe that we should be pegging the rents to slightly below market for a valued tenant to prevent those changeover costs. So yeah, there's quite a bit involved with it, but legislation at the moment is such that you should be looking at 6-month leases so that you can look at negotiating new rents.
So if you put a tenant into a property today, and it's like Christmas Eve sort of thing, just before Christmas, it's start of December, and you put them in for 6 months, when would you be able to issue them with a notice to increase their rent? Because you have to give 60 days notice.
Yeah, correct. Our processes start between 120 and 60 days out from that lease finishing. So we start negotiations with the owner. Would you like to offer this tenant another fixed term lease? Here are the good parts of this lease as it stands. Here are the negatives. This is what you could be expecting to get for your property. If you leave them in situation without changing them over, that's all good. This would be the cost if you do change them over, the potential cost. So we work on that over that period of time. We then offer it to the tenant. We give them a week to say yes or no. We get them signed up, and so that particular lease is then from 60 days out, they have notice of a rent increase, and then as soon as that fixed term date finishes, they're onto their new lease.
Thank you, Chris.
Question, Chris. Sorry.
Yeah, go, yeah.
The question is, a periodic lease and a fixed term lease, is the landlord equally protected? I know they could move out, I suppose, with warning, but I think a lot of people think if someone's on a periodic lease, that the landlord's not got the same kind of protection. What's the difference between a periodic and fixed?
The periodic lease has no fixed term end date. So once it is signed by the tenant, they have occupancy on that particular property until such times that there is notice given. If they want to vacate the property, they must give 21 days notice. If the landlord wants them to vacate without a cause, if they want to do renovations, whatever, they must give 90 days notice. If the landlord wants to sell the property with the tenant in it, they can by giving a 14-day notice of intention to sell. And if the contract has, and Stephen, you can tell me if I'm right or wrong here, but I'm pretty sure I've got it right. If the contract has a vacant possession clause in it, then once it settles, they have 30 days to vacate.
Yeah, so in New South Wales, if the contract's marked vacant possession, if it's a periodic tenancy, then I believe that you can give the tenant a 30-day notice to vacate.
And can the new buyer offer the tenant a lease, I suppose?
Yes. Yes, they can.
Yeah, during that, like the cool off, yeah.
So it's like a mobile phone contract. You sign up for 12 months. After that 12 months, your phone doesn't get disconnected on 12 months. It just continues on. You keep paying your monthly bill of your phone plan. And then if you want to cancel, you can go and say, hey, I want to cancel, and give them the required notice that you have to do. Same thing with a tenancy.
So to answer your question, Gemma, does the landlord have the same rights under periodic or a fixed term lease? Yes, they have a residential tenancy agreement with that tenant, and that is covered off under that agreement. So whether it's a fixed term rolling to a periodic, or if it's a periodic from day one, they both still carry the same weight.
And would a new buyer, sorry, I have lots of questions with this one, but just one more. Would the buyer, for example, if the tenant has had an increase, say 3 months before they sold the property, is the new buyer then subject to another 10 months, or no, 9 months, even though it's on a periodic lease?
Correct. The legislation states that that particular tenant in that property cannot have more than one increase in 12 months.
Okay.
So if one of your clients buys a tenanted property, they inherit the tenant and the lease that's in place, and the ledger, and any transactions that have happened to that property for that period of time. Okay.
Thank you, Chris. Next question here, asked from Josh. Global population just hit 8 billion in a world. If there is a population decrease, how will it affect house prices and rent? I just saw an article that came out from news.com that there was an 11% increase in deaths in the last year. I don't know why, but apparently there's an increase in deaths. Some people have fears, if there's a pandemic or, something happens, whatever reason. I think we're very protected here in Australia, right? Like, we've got 25 million people out of the 8 billion people that are existing on Earth. There's a lot of people without shelter. We need to bring people into this country. We ain't going to see, unless we're going to see an apocalypse, I don't think we're going to see, let's say that half the people in Australia didn't, something happened. I'm sure there's lots of other people that would want to come in, and I think we'd all have much bigger problems than that. So it's actually not even a concern of mine, but it's a question that was asked from the community. I do see the risks that are out there. I see the inherent risks of, we've been locked down for 2 years. There's things that are happening that are very odd out there. It is a very important question, but it's not something that I haven't really spent any capacity. I think if we saw half of, the ice age come and half of the Earth's population, cease to be, then, I would consider that would have to reconsider our positions. Would money be the most important thing, and building wealth and property I'd probably have different concerns at that point. So, yeah, any other feedback from anyone? It's a bit of a random question. It's a conspiracy theory style question.
I think you'll probably find that if you're worried about that, you're probably worried about sea levels rising. You probably lose as many houses as fast.
Yeah, well, next month it's going to be climate change, guys. So you better watch out what they're going to be talking and forcing down our throats at that point, and all our houses are going to wiped away. And the good news is for all the people that live at Penrith, that's going to probably be the new Sydney Harbour if that was to occur. So say that with a bit of jest, but it is something that it is a question. I have actually made points. I've had them offline discussions with Ridhwan previously about my thoughts if something was to happen with an illness or a fallout from an illness or something like that. That, you know, if I saw that there was a 30% increase, or like 30% got wiped out from an illness that occurred or something, then I would probably reconsider and look at it and go, hey, what's going on here? But we have so many people here that in the world that, you know, want to move to Australia. We've got so many resources in our ground. We could, you know, see a lot more people want to come here. So yeah, I don't see it as an issue for me. This question here, I've got here my name here, asked by Evan. Do you recommend purchasing a business with the cash, then the equity from our current properties plus the increased income from the new business to purchase properties? That's a loaded question there, actually. Rose said at the start of tonight when she introduced herself, and she said she knew me from the point when I said I wanted to quit my job back in 2009. I realized that my earning capacity was irrelevant and it wasn't going to help me any further with, you know, servicing. So I realized there was a position where I was like, stuff it, the payslip doesn't mean anything anymore for me. I didn't go and set up a business first because I knew that the problem with financing was having the business. So there's lots of variables with your question. Depends what would happen. It's all about the finance. So the property accumulation, it's a banker's game. You need to understand what the banks are looking for. Do you have a job or do you have a business? There is an extra part of this question that I am seeing here, and it says the extra part of the question, I've recently sold a business and want to buy another or purchase properties now and use the rental income and equity to finance a new business. So I guess you can pull out equity from your properties to fund the business. The one thing that I would suggest, and I'm not going to ask Rose to answer the question. I'm just about to say something. Sorry, Rose. If you were to sell your business off, if I was to sell off a business, I would look at all the things that I'm selling, whether it be a book value, assets, the fixtures and fittings, whatever that case may be, and be thinking to myself, they're a part of my business, right? So if I sold off that would then be derived as income to my business. If I sold the whole PTY Ltd and got rid of the business and closed it from the sale, well, then I wouldn't have a business. Then I'd have to wait 2 years to start a new loan. So if I was to sell a business and be in that sort of position, I would be thinking about the nature of that transition and how it would affect my bottom line. Because if I'm selling off all the fixtures, the fittings, if I've got a takeaway shop, I'm selling off all the cupboards, whatever the case may be, and that has a set figure, then that is technically income underneath that business. So it could actually be quite beneficial from that perspective. You're paying tax and that's derived as income. So I think that would be more of a question at the time of disposal of the old business, which you'd need to speak to your accountant and get some tax advice on that. You'd need to speak to your finance person to see how the finance would be considered on that front. But you would need to work out prior. I've spoken to people who are like, I've just sold and I've closed down the business and all this sort of stuff. And yeah, it's very important that you plan for this. Just like anything else, it's about planning. Rose, what were you about to say? Did I answer it? Or
No, I'm just about to comment that if you have to use your residential property to harvest equity and purchase a business, then that become a commercial loan.
Yeah. Okay.
Because the purpose is, so you need to consider also the interest rate, commercial lending, that sort of stuff.
Yeah. Okay. Any other comments, Steve, Reid?
if you're buying a business, there's only so much security you can get against the business. So if you're looking at it insofar as maybe relying on the business to draw more equity out, well, that's not going to be possible. Is that right, Rose? Like, how does it work with you can't?
You can't really borrow against a business anyway. It's always brick and mortar to support the business. The only exception, if it is like McDonald's or franchise, that sort of thing, right? The bank may consider it like franchise, but like a business, you want to buy a takeaway business, you can't borrow money based on the business income or whatever. It has to be, you need to come up with a cash or an equity from your existing property to fund that business.
Very important to get the right advice on that front. But do I recommend, to answer the question, do I recommend purchasing a business with cash and using equity from our current properties? It's important to have the strategy. There's too many missing points in this question to be able to give a clear answer. I can see that's asked by Evan. It might be something worthwhile having a chat with the investor relations team, which would be Gemma and the team. You can send us an email, reach out to us, and the team will point you in the right direction after getting a bit more information from you. This one here is a question asked for Chris by Andrew, but I think this one here would be a very easy one for me to answer, which is, does Blink Property look after properties in Townsville and Queensland? How often are visits made to do the inspections? Do you have that info with you, Chris, because you're based in New South Wales, or should I answer this one?
I do have the info, but feel free, then you can just get on a roll.
You go.
Yes, we do look after properties in Townsville. We look after properties in Cairns. We look after properties all throughout Queensland. Our agents in the areas treat your property like it was their own. They will do inspections twice a year by default, and more if it is required with additional cost. So yeah, we are Blink Property, New South Wales, Queensland, soon to be reaching out around the rest of the country. We have great geographical boundaries, but we look after the properties all the same.
We've got so many people. I know that our national operations manager is currently in Townsville, because we're one of the largest real estate rent rolls now popping up in Townsville. So just like we took over, certain locations, we've got, very large footprint there. So we can look after your property, no matter if it's in wherever it is in Queensland, we can take care of it for you. So reach out to the team if you do need help. This question,
New South Wales as well. We look after the whole of New South Wales. If people want to reach out and get any information around that, I'm more than happy to field those calls.
I just saw, like, people won't see what's on this side of the wall, right? I'm in the office. We've got 2 offices in our building. I'm upstairs. There's some plants behind me. It's always white walls and stuff. It's like a hospital around. I like white walls. And then there's a window here, and I'm actually looking out. And Chris, this is like 8:40 at night, and one of your staff is still here. I just saw them go and wipe something off a whiteboard. They're working at 9 o'clock at night. So when you think about it, like, when's your property manager asked you anything about your goals? When's the property manager asked you, what are you trying to achieve with this property? When has your property manager been here to take your calls at 9 o'clock at night? Like, that's very different. So if you have a property, whether it's New South Wales, Queensland, wherever it is, and it's not being managed by Blink, you're doing yourself a disservice. So yeah.
Thanks, Nathan. Can you tell her to go home now?
I can't, because I'm not here. I can yell out, but yeah. Next question here is, would you agree that trust that's making a profit will help with serviceability is tight? That's a question for Rose.
No, I'm not sure what sort of trust. Is this a trust like a trading trust, or is it a trust that is really just for property, So if it is a trust where you derive your income, obviously, that income is, correct me with this, Ridhwan, that income has to be fully distributed that comes from the trust, right? Yeah, but if it is a trust that just like holds the property, we can take that income if it is a positively geared, but we also have to take the liabilities. But nowadays, the ANZ, Bankwest, MeBank, if you are borrowing under your names and you get a lot of borrowings under the trust, sometimes we disregard the trust borrowings as well as the income, and sometimes servicing is better that under your personal name, only your personal liabilities are carried forward. But trusts that are profitable just for holding the properties, I haven't seen a big profit in trust that's just holding the properties. They might be self-sufficient, but I don't know. Yeah, we can use it, but we need to take into consideration the debts as well. So you need to weigh it. Is it really beneficial to take the profits of the trust and take also the liabilities?
In some instances, I've seen where you don't have to disclose it. Like Rose said, they don't care about if you've got properties in a trust. They don't want to know. They just want to know your personal name, which can be in your benefit to have them under the trust in that instance. And I've seen, which was a conversation we had last week, and one of my investors just texted me, made me think about this guy, where he wanted to buy some properties under a trust, but then the bank factored in negative gearing credits because of the property appreciation and all that, and said that basically we couldn't borrow for it under the trust, but we can under the personal name. So it depends case by case, and it's the importance of speaking to the team. So if you are thinking of building the team, building your portfolio out, speak to the team, be it Rose, be it Zinger team, be it Ridhwan, be it the One Path accountants team before you do that. If you do want to get more clarity around it, I think it's very important case by case to look at. So thanks, Rose.
So you have to remember the properties that are under the trust, you can't have any negative gearing effect.
Yeah.
Only negative gearing effect is only if the property is under your personal names.
You don't want to get your
correct
gearing credits trapped inside the trust. Otherwise, it's
Yeah.
Next question. I noticed there's lots of questions here, so I want to spit through them really, sort of sharply. This is a question here from Bruce. It says, what is the prospects for non-Australian citizens to invest in property in Australia? I guess, Steve, can you give us the background as to what a non-Australian citizen can invest and can't invest in Australia?
Yeah, so if you're a foreign resident, generally you'd need to, if you want to invest on your own, you need to get FIRB approval, which is from the Foreign Investment Review Board. However, if you're investing with an Australian citizen or permanent resident, that may not be required. However, if you are permitted to purchase, then there'll be additional stamp duty that'll be payable. So I think it's like 8% of the price in additional stamp duty in Queensland and 7% in New South Wales.
I really know how to
So
spit it.
Stephen, say for example, one is a citizen or permanent, has a PR, but the other one is a foreign. Do you divide the stamp duty between those two?
Yeah, so it's that person's interest. So if they've got a 50% interest in the property, then only that 50% interest will be subject to the additional stamp duty.
What about if someone was to own it under a company and that company was to be owned by someone from overseas?
Yeah, that's right. So then it would be the shareholders or the beneficial owners of that company that would be under scrutiny. So if they're foreign, then again, it would come down to that company or that buyer being foreign, and they would also be subject to that additional stamp duty. And it also extends to trust
as well.
I've just seen a question come through, and I've got lots of questions here, and I'm just trying to get through our questions here. What about New Zealanders? Does that make any difference if they're from New Zealand because they're just across the road from us?
Yeah, so there's an exemption with New Zealanders. They're said to hold like a special category visa, and as long as they're permanently residing in Australia, if they're New Zealand citizens, then they're exempt.
Okay. There you go, Chris. You're ready to go, mate.
Yeah.
Awesome.
There's also the foreign land tax surcharge, so you've got to be aware of that as well.
Rose?
I'm good.
Okay, great. While I'm saving to get my next deposit ready, is it possible to get a file set up with you guys now to prepare for a fast purchase? I don't know what this means, but maybe for Rose and for Gemma to answer that question. So while I'm saving for my next deposit, is it possible to get in the system with you guys and prepare myself for a fast purchase. So yeah.
From the first part of call is the investor relations. From our side, absolutely. Some of my more like smooth running clients, they've been speaking to me say for 6 months and they've asked all the questions and they really know what to expect from the process. So to be fair, I'd probably recommend talking to us before you're actually ready, to give you that time. Some people will have cash ready to go and like, let's go spend it, let's do it, and they haven't taken that time to really understand what's happening, and might freak out a little bit halfway through. So absolutely, we can educate you, which is the most important thing anyway.
I remember, a lot of you guys might remember ex-business partner of mine years ago, Daniel. I remember when he started his journey, and before I met him, he had looked around for about 3 years, 4 years, wanting to get into property, and he was trying to get into property, and just it wasn't, you know. And we were chatting every day about getting into property and all that sort of stuff. I remember his first month, he said, I want to get 4 properties in my first year to be great. And then he bought like 4 in his first month, right? And all that 4 years of, you know, researching and getting himself right prepared him to get 4 in a month. Then he got 10 in the first year, and, you know, build it out from there. And, you know, there's lots of people I can see that are in this chat do similar sort of position. Rose?
Well, for finance wise, it's not necessary, because we always we need to have at least 6. We cannot have details or documents less than over 6 weeks. So to have them in our file, it's no use to us, because basically we need, you know, at least 6 weeks of documents to be there, and having you in our system. What does it do? We still need to assess you.
How long does a pre-approval last?
Pre-approval will last for 90 days, and then after 90 days, we will then, if it goes 90 days, we'll reactivate it by submitting new set of documents.
So you can have a pre-approval for 3 to 6 months.
Yeah.
Yeah. Okay, cool.
It's also worth mentioning, whilst you are saving for a deposit, have a chat with someone to see. It might not be, you might be striving to save more than what you actually need. You can get into the market with a lot less than what people think. Some people will say, oh, I've only got 200k. Like, that's fine, like, let's go. But yeah, so, you know, 50k, it's not, you're not needing hundreds to start.
There's a guy that I'm catching up with next week for a portfolio review. He came to me, I remember 3 offices ago, we had a meeting in the coffee club down in the old office over there years ago, and he wanted to get started, and he's just pulled 300,000 worth of equity out of 4 properties. I only ever bought him 4 properties. He pulled 300,000 out. I'm like, dude, we'll get you another 10, 15 properties. And he was scared about some of his properties that he bought back in the day. And about 2 years ago, he asked me, should I sell my Gold Coast ones, you know, that sort of stuff. I said, no, hold them. And he's messaged me on Instagram. And he's like, bro, I'm ready to go, blah, blah, blah. This is so good, etc., etc. And I remember at the start, he couldn't get started because he only had like 5 grand or 10 grand, and he scraped and he hustled his shit together. He bought a property in Newcastle region of Sydney for about 150,000 for a house on land. That thing's probably worth 700,000 now, 800,000. So a lot of people, as Gemma just said, think they can only do X amount, but they don't have enough. This guy, you know, hustled his way through, got his foot in the door, and is in a really cool position now. So yeah, it can start from anywhere. Do you think, this is a question for Ridhwan, do you think interest expenses and other expenses for investment properties will always be tax deductible, or could they change this one day?
Yeah, look, it's a good question. So in New Zealand, actually, they've done away with negative gearing in part for investors. So there are some changes. In Australia, they've actually got rid of, they've abrogated or redacted certain parts of expenses that you could claim once upon a time, travel, certain parts of depreciation, for example. They've done a lot more testing and vetting from the tax office in terms of bank fees and valuation fees, etc. So the short answer is yes, all of the tax deductible elements, or the ability for you to be able to claim everything and anything in terms of maintenance of that property, could be changed. So which is why we've always said is that buy property on its merits, not on its tax merits. The tax side of things is always a nice to have. You can use it to help you fund out cash flow. You can use it to your advantage as long as it exists, but it may not be there. So, you know, there's a big undercurrent in Australia, obviously, with the housing affordability and saying, well, investors shouldn't be able to, quote unquote, benefit from unrealized gains and stripping out or harvesting equity, but at the same time having tax deductions to help them hold the properties. So, you know, there was a consideration to limit negative gearing losses to ensure that the property was neutral only. So if you had $20,000 of income but $30,000 of expenses, you could only claim expenses up to $20,000, and the $10,000 would roll forward, finish the capital gains, or be delayed in some way. So yes, the short answer is, could they change? Yes. Will they change? Yes. When they change, we don't know, but it will certainly happen at some point. So it's always good, again, to buy properties which are properties which you want and help will get you to where you need to go. That means that you might buy a property on tax basis now and sell it potentially. But yeah, it's always good to have properties that are going to work regardless of what the economic conditions are and what the tax conditions are.
Sound advice there, Red. Next question is for Stephen. This one is just a general cost to set up a basic will. Steve, how much would a will start from?
Yeah, $550, and it's 2 consults. So the first consult is to take an instruction, and the second one is to have it signed and witnessed.
Cool. And then another question here. If I pass away unexpectedly, then person A, B, C gets X percentage. Y, Z, I don't understand that part, but I'm thinking, can you split up the will to say this person gets this person gets that, like percentage-wise? Like, what sort of parameters are around the will?
Sorry, was the question if I die without a will, or was it if can I put this in my will?
Yeah, so if you're building a will, can you put in there, if I, like, say for instance, if this person died suddenly, then does the person A, B, C get X percent, and does X, Y, Z get X percent? Like, can you split that up?
Okay, so we'll split this in 2, right? So if you die without a will, then your assets get split in accordance with a set formula. So it basically works off next of kin. If you make a will, you can basically distribute your assets in whatever portions you want to whichever beneficiaries.
Beautiful.
Just a question, Stephen, because I have a lot of foreign investors and being a foreigner myself, can you set up a will to, all my family's in a different country, so can you do that? Can you will them to someone in a different country?
Yeah, so if you make a will in Australia, then what we usually recommend is that any assets in Australia, then you make your will in Australia, and your beneficiaries can be overseas. But if you've got assets in another country, then you should make a will in that country where the assets are.
And I've got a really random one here, right? This is like just really random. It just made me think about the last question. So let's say that Gemma's here in Australia, and this is really, I don't even know why I'm asking, it's just for fun, because it just popped in my head. If Gemma's here in Australia, she's got 10 properties, 20 properties, 50, let's just say 10 properties she's got, right? Just make up a number. She's got 10 properties here. She passes, right? And then it goes to the person in the UK, right, that inherits her will. And because they're not an Aussie citizen, how do they own the property then? Do they have to pay a stamp duty or some sort of tax or something because they're not an Australian citizen?
So it would be up to the executor to decide what happens. So as far as like when you make a will, you appoint an executor, that's your legal representative, and it's up to them what they decide to do. So if you've got foreign people that are beneficiaries of your assets, then the executor might just decide to sell off your assets and give them the cash. Okay. Because otherwise you can't, if you're a foreigner, the same provisions would apply to owning property in Australia, even if you're a beneficiary. So they might just sell it off and give them the cash.
Okay. So I ask Steve these most random questions all the time, right? It's the only way you guys learn is by asking questions. So that was just something that popped in my head. This one here is a question for me and Ridhwan. Here it says, once we move to a central bank digital currency, will the rules of the game still be the same, or would we need to learn a new set of rules? For example, the definition of M1 money supply will change significantly since there will be no more cash. Once this is introduction of the CBDC, is that a good opportunity to take advantage of this new currency? Question by Stephen. Not this Stephen, a different Stephen, with a PH, not a V. So my answer to that is we will move to a digital currency. We will lose our currency very shortly. You are being forced now to use a digital currency. You're not allowed to use cash. You go to the shops, they're trying to force you to use a digital credit. You go to the shops, you can't find a bank that's open, you can't find an ATM. They've removed ATMs from everywhere. We are certainly going down the road of central bank digital currency. I believe that we'll start seeing that somewhere in the later part of this decade. We'll start seeing it now, but really being forced and railroaded into using that probably after we see hyperinflation occur. My thoughts on rules of the game still being the same, or will they need to be, a different set of rules? I think that the whole game will change. People will sit there and go, I've still got $1 in my bank account, but how that dollar operates, it'll still be called a dollar, it'll still have the name of it, but it'll have nothing that operates like it. It's like your favorite food as a kid, or the favorite, whatever it was that you remember as a child. Yes, you might have that brand still out there, but what it does or what it tastes like or whatever will not be the same because it's made up of totally different ingredients. Over to Rid. Do you have any feedback for that as well?
Yeah, so look, I think the best way and what most experts try and do in terms of bringing your mind to some level of ascendancy to what it would feel like is frequent flyer points. You get a lot of them, but you can only do certain things with them. They get burnt, or they can get transferred at certain rates, for example. So I think that's what Nathan is referring to in terms of how it looks and feels like. It's an equivalency of a currency. Operationally, it might work slightly differently. In terms of the new set of rules, there'll certainly be a lot of tax changes when it comes to these type of things, generally because of the speed of what you could do and the way the money would be tracked. So, there might be tax taken at source. They already do that, Stephen. You would know, when you're selling new properties or near new properties, they get you to take the GST out, but they might just cut out a lot of these different things. So when you're actually selling a property, they go, okay, great, you should have paid tax, take it out of your bank instead of getting people like Stephen or myself to actually do these things. So there'll be a lot more invisible hand, which works, which you won't be able to see. So there'll be a lot of new rules changes. The fundamental principles of the tax on how these things work and how they interact with your assets and in your life will work the same. But I think it will be a lot easier for governments and whatnot to engage in individual, unique citizens' financial transactions effectively.
Social credit system, if they don't like you because you've, I don't know, been buying alcohol, they don't like you because you've had too much meat, they don't like you because you're driving your car that's diesel, and they don't want you to do that. They can turn you off, they can limit how much you can buy of certain things. This is very evil, right? And I don't want to go too deep into it because I could go on for hours, but central bank digital currency will be money that's programmable. It'll have a time. You can only have a timer on it to use it. There's only certain ways you can spend it. They say, well, we don't like that business over there. We can turn that business off within the system. It is very socialist, communist, totalitarian, fascist, very social credit system. If you want to go and research a bit into a social credit system, go and research what's been happening in China over the last few years, and that's the same sort of system that's being implemented across the rest of the world using the central bank digital currency.
Yeah, so I think it's kind of like if you are speeding and you've got a car which reports that you're speeding, the money will get debited out of your account instantly.
Yeah, exactly. Next question for Rose, very quickly one here. Are there any additional requirements lenders look for when assessing a loan supported by a business versus a loan for an employee?
Well, definitely easy to borrow is the PAYG, less documents. You just need pay slips and to verify your income. Whereas with the self-employed, you need financial statements and sometimes the individual tax return. So in assessing the loan, I think the easy one is the PAYG. Is that the question?
Yeah. Which one's easier? You know, is there any additional requirements? They're very different. Sometimes good, sometimes bad, depending on, you know, how the bank views you and your business and your setup. This one here is a question for me and maybe for Gemma. What do you see as the best type of property to invest in this current market, and how long do you hold on to it for? For me, I like buying things and holding on to them forever. I don't like buying and selling and flipping properties. I've never had anyone call us up and say, hey, Nathan, I'm so happy I sold a property 10 years ago. I made 200 grand on it. Then always like, I wish I bought more. I wish I didn't sell. The thing's worth double again. You know, as for what's the best type of property and what sort of time frame, I like stuff that the bank will lend on. This is not a property game. It is a finance game. Understand how the banks work, understand what the banks need, and then you can buy the assets and put on to what the banks need to try and tick their boxes to make them happy to give you more money. So the types of properties start off with fundamental properties, foundation properties, which are, you know, little houses, little units, little duplexes, house villas units, whatever it may be. Then once you've got that foundation laid, you can go back, pull out equity, you've got the cash flow coming through, the banks are happy with you, you've got diversification, you've got liquidity. If you start off by buying one big block of units, something goes wrong, you have to liquidate that whole block of units, and then, you know, you have to then have no property and start off again. So it's important to look at from a liquidity perspective in your portfolio and look at how you're going to construct your portfolio for risk minimization as well along the way. So yeah, looking at it from that perspective, it depends on where you're at with your journey, depends on what type of property. There's all different good and bad. It's probably more of a map session that we're having. Gemma, do you have anything to add on that one?
I think the only thing I'd want to add is that every market has something that's scary and why we shouldn't do it, because nobody wants us to do it. We're not supposed to get financial freedom. So I think in this current market, the devil is the interest rates. In the next one, there'll be something else, and there'll be something else. I think for me, as long as you're buying something in this current market, you're edging your bets regardless. So I think just to keep active is probably the most important thing.
And I've got a really cool question here, which is, how can a married couple with an income of 300 grand a year grow their portfolio to 15 to 20 properties without having to pay a huge amount of tax? This one, I could do a whole webinar on just this one sort of topic here. So, you know, 300 grand a year. Gemma, what's the average income our investors would have that have 10, 15, 20 properties? Do they have 300 grand a year?
Absolutely not. No, it's less than 100.
Less than 100. So 100 grand, maybe a couple that's on 200 grand, and they'll build a portfolio of 10, 15, 20 properties. So you can, to build out a position of, you know, that size portfolio, you don't need to have massive income. 300 grand a year, way much bigger than, you know. Rose wrote my loans, and I was scratching just over $100,000 a year working 2 jobs to get to 100 grand a year when she built my portfolio to the first 20, 25 properties before I quit my job. So you don't need, you can definitely do it on that. As for, you know, not having to pay a huge amount of tax, tax is something you can minimize. We've got Ridhwan here. I'll get him to answer that question, but you can have a very positive property portfolio and minimize the tax from depreciation and other sort of ways in your journey as well. And once you get 15 to 20 properties, there's certain properties that you need to add into that portfolio to help reduce the tax amount, and how you structure yourself is important as well. So Rid, maybe if you want to answer that part of the question.
Yeah, look, so it's always the chicken and egg, or, you know, one versus the other. And similar to before, I think if you look at anything in isolation, then yes, if you're paying $300,000 of tax together, sorry, if your income is $300,000, you're paying a pretty significant amount of tax when looking at together. What you do need to do is to realize that if you're purchasing a couple of cash flow properties, or properties which are going to help you from an independence point of view, then that's part of that journey, because when you start to be able to get some real cash flow out of it, you can reduce your working engagement, and that brings your tax bracket down. So then you've got more time and you're back to where you start. We always say to clients all the time is that if you get to X amount of properties and paying X amount of tax, and that gets you to your financial independence scenario, then it's a job well done, right? The goal is not to pay zero tax. The goal is to have financial independence, right? But in terms of direct tax advice, yes, as Nathan says, some types of properties will offer depreciation. Some types of properties will offer, different types of deductions, which you may or may not be comfortable with. So some have larger strata, some have larger land tax. All these different things will affect the property portfolio, the outcome, the tax position of it. You can obviously, if you get to a certain point in your property portfolio, contribute more to superannuation. There's a whole bunch of different ways you can reduce tax. But when you say without having to pay a huge amount of tax, I think it's important to strategically understand that you might pay more tax in the first 4 years, but over a 10 or 12 year period, you've got to blend that out and see how much tax you're paying over that time, right? So if you get 4 or 5 properties, which doesn't help your tax position initially, but you get 7 or 8 properties, which really, give you a lot of depreciation, or you're in the position where you've got additional cash flow that you can contribute to super, that can help you from a tax point of view as well. So you've got to look at it in totality. And I think that's one of the fundamental problems with property investors, property guys who are advising. It's always transactional, it's isolative, it's always unidirectional. It doesn't work both ways. But if you look at a journey, a property journey, it's got its ups and downs, and you get to a certain point.
And if someone has 300 grand a year, they're going to be slaughtered with tax. When you have 300 grand a year and no properties, then you don't have anything to really help you minimize your tax. If you've got 10, 15, 20 properties, you've now got lots of other levers there to pull, and things that you can use to minimize your tax and whatnot. So the other part of the question that was here that I saw on another screen was that they are at the limit of reaching serviceability after 5 or 6 properties. If you're got 5 or 6 properties and stuck, we've got clients that are on 50, 60, 70 grand that are at 5 or 6 properties and they're getting stuck at that level. So, 300 grand a year, Gemma has a client that's got over 30 properties in 18 months and they're on 300 grand a year. So I think something needs to change with the strategy, from a finance strategy, an acquisition strategy, and the properties and the taxation sort of strategy. So do reach out. Like, that's a whole conversation on a different front. Do reach out. Maybe Gemma or one of the other investor relation team members will be able to get a little bit more information, be able to point you in the direction to get you, over that hurdle, because getting stuck at 5 or 6, especially with 300 grand a year, that's not a cool spot. It's definitely a lot that you can do to overcome that. Here's a question for Rose. With the interest rate rising so much recently, the buffer rate is the buffer rate still 3% to assess your borrowing capacity?
Yeah, it's still 3%. So 3%, as I said, the actual rate plus the 3%, that would be the basis of the basis for servicing.
Okay, great.
So if you're getting a actual rate of 5%, then plus 3, that means the stress rate or the benchmark 8%. Yeah.
Thank you, Rose. Here's a question that's asked in by John. How do your clients buy a few properties a year when the debt to income ratio increases? What are some strategies to keep buying? Rose?
How do you classify a few properties a year when the debt to there are some lenders that don't have DTI, right? For example, First Mag, they removed the DTI. Now, to increase your property portfolio in a year, you need to look at the yield. It's very important. You also need to buy properties that are not so expensive. You look at Sydney, for example, you get we've seen it all the time. Property bank valued it for 700,000. There's only 4% yield. Now, I would be looking the yield ideally between 6 to 7%. That could probably push this servicing. And also maybe 300 less than 400,000 properties. That's more affordable. And in that way, you can basically service and buy more properties. And as I said, always look at the yield.
So cash flow, like we've got people that might have 200 grand equity, right? If you're stuck at servicing, it means that you've already got some assets there. You might be having an issue getting the equity out. It might be an issue getting access to the capital. If you have an issue with that, you might be sitting there going, hey, I've got 100 grand in equity, 200 grand in equity. You could literally buy a little property for 100 grand, 80 grand, 120 grand. We had a duplex recently that we did for 125,000 and it had 2 tenants in it at $250 a week, so like $500 a week on a 125,000 purchase. If you buy that thing cash outright, that naturally is going to help boost your yield without having debt attached to that, which will help with the servicing. So there's lots of different strategies. It's probably more of a one-on-one sort of strategy that we need to discuss. I
was just looking at the servicing aspect of it.
Yeah. Next question here is, do you need a tax depreciation report for every investment property you own, Rid?
Good question. So the short answer is no, but the longer answer is that you should always check, right? For the guys that we use in terms of depreciation, they'll give us an estimate of depreciation on a particular property. Those depreciation report companies have a lot of data when it comes to properties next door, adjacent, around the corner, same type, same size, and they can tell you, hey, you might have $3,000 of depreciation for the next 10 years, so you'd probably go off and get it. If they say you got $300 worth of depreciation each year for the next 10 years, you might give it a miss, right? So not every property deserves a depreciation report. Every property is entitled to a depreciation report, but we generally get our clients to check. We get the depreciation report companies to give us an estimate. That estimate is generally quite reliable, and then if it's worthwhile, we go off and commission it. So we sort of measure twice, cut once in that regard with depreciation. If you have a new property, a lot of the bulk deals that we did, that Nathan did in Fletcher and Thilmy and other locations, they're brand new. So it's a no-brainer. You would get depreciation reports on that. And to be honest with you, you'd be surprised how much depreciation you can pull out of some of the older properties, especially in the first, 3, 4, 5 years of ownership. It does make a difference.
So I guess any property that's built after 1990, you should at least explore the idea and the concept of it, because there's the ability there. Thanks, Rid. I've got a question here for Stephen now. Steve, the question here is, do you need a power of attorney to protect yourself if something unexpected happens to you?
So a power of attorney is where you nominate someone else to take care of your financial affairs in the event that you lose capacity in the future. That's an enduring power of attorney. So yes, it's like taking out an insurance policy. You may never need it, but we do recommend you get one. And to accompany that, we also recommend you get an enduring guardianship, which is to appoint someone to make decisions about health, lifestyle, consent for surgery in the event you can't make those decisions in the future.
So Steve, what's the difference between the enduring and the absolute power of attorney?
Yeah, so a general power of attorney, you can nominate somebody to make financial decisions on your behalf upon your instructions. So, if you went overseas and you need someone to sign a contract or go to the bank and take money out, they can act on your instruction. That's a general power of attorney, which means they can act while you have capacity to give them instructions to act. An enduring power of attorney is the one that it continues to be effective after you lack capacity and can no longer make decisions for yourself.
Mm-hmm.
In the weird world we live in today, everyone should be looking at these things and choose carefully who they're going to appoint to look after their position if something goes wrong.
So I'll have to look at who is among my kids that are good boys, right?
Absolutely. Someone you can trust. Who's going to be aligned with what you wish. So, yeah. Thanks, Steve. Here's a question from Tyler. This is a question directed to me. Is it okay to buy a property now in Tasmania or hold off? For me, I'm not here to tell you where to buy, what to buy, not to buy. I own 0 properties in Tasmania, and I see that there's much better value. Tasmania has gone up a lot. I like buying. I'm a contrarian investor, so I like to buy in markets when things are suppressed, not when they're hot. So that's why, we look at the Gold Coast, for example. It's gone crazy. Everything's gone great. We bought when the market was suppressed. Now it's being dragged up. We want to go to the areas where there's good value. In Tasmania, I'm not seeing value. If I saw value there, I would go and buy there. I think there's a better value attached to the mainland with more upside, with infrastructure that's being put in place, plus migration into where we're at. So that's just my view on that question. Here's the next question for Rose and for anyone else to join in. What are the alternative ways to continue investment journey with the tighter lending requirements?
You
Do you want me to answer it?
yeah, answer it, yeah.
Okay, so some alternative ways to continue your investment journey. Very, very important, right? Like you could be told, no, you can't finance, but I always ask, well, what is it that you need from finance to be able to service? So when I'm speaking to my investors, I'm sitting there thinking, okay, in your position, finance says you can't get a loan because of X, Y, Z. Well, how much do I fail servicing by? You might fail servicing by $100 a month, $500 a month, $1,000 a month, $5,000 a month. If you're failing servicing by $5,000 a month, you need to earn an extra, $1,200, $1,300 a week. That's going to be much tougher than if you have to earn an extra, $200 a week or $1,000 a month, whatever the case may be. So finding out exactly and identifying what the issue is, and then trying to work backwards to be able to get back on the bandwagon to push your servicing up. That could be, you might want to sell a property. You might want to look at, okay, I'm stuck. What's causing me to get stuck? What's the biggest thing? And then working out, okay, is this property, a lot of people sit there and say, I'm attached to the property, I've got future potential, yes, but then you need to make a decision and go, what's the opportunity cost? You could buy 10 other properties if you had this one property that's holding you back. I think it's really deep diving into the strategy to see, okay, what is it that's stopping you? What's blocking you? And how can you turn that roadblock into a building block and get you moving forward? It could just be that you have to shuffle a few things around your portfolio. Now, I know one investor that would probably be watching this, they're not watching tonight, they'll be watching it tomorrow. They got stuck and we were able to, they sold off one property. They couldn't move forward. As one of Gemma's clients said, I need to contact them regarding their principal place because we're looking at building their principal place. But this client, I think they've got like 15, 18, 20 properties, something like that at the moment. And they had one property and they're at like number 10 or 11. And this investor said, I want to be like everyone else that I see in these articles and stories of pushing forward, buying 10 in a year, whatever. I said, look, there's a few things holding you back. We identified how much is missing out from servicing. There was a block of land that they were pushing forward to build on. We decided to sell the block of land at a profit, then redeploy those funds into buying 3 cash flow positive properties. By doing that, A, we're reducing the debt position. B, we've added an extra $1,000 a week worth of rental income through. What that enabled to do was enabled that investor to then be able to refinance and restructure their debt that was at 7% and reduce them back down to 4% or whatever it was at the time. And then that position enabled them to pull out about 400 grand worth of equity. And then we use that equity to go buy another 4 or 5, 6 properties, whatever it was at the time. Now that investor has almost 20 properties in their portfolio. They were stuck at 10, we're able to get to 20. Now we're looking at the position of, okay, if they can't service now or they don't have the deposit, how are they going to spend $2.5 million on their dream home? It's like, okay, maybe we need to dispose of one of those other properties that went from $500 to $1.2 million, take out the profit, use that as a deposit, and now we've reduced some debt. We can then go and add in a new purchase. So it's really just working out and reverse engineering where you're stuck, what got you to get stuck, and how to get back onto that journey. Any other points or thoughts from any of the team?
I think what you just said then kind of ties into what we said earlier about a property just doing its job and knowing when to get rid of it for the next step. So they're all just vehicles, and people get too attached or too loyal or too emotional to a particular asset. But that story really just shows that an asset has a job to do. Once it's done its job, or it can serve a different job, then we need to offload it.
Exactly. Thanks, Gemma. Here's a question for Chris. This question is, how often should you look at increasing your rents on your investment properties?
Yeah, hands are tied by legislation, unfortunately. So if you're on periodic, as I said before, you can only do it once every 12 months with that tenant. If you're on fixed term, you can do it twice a year, unless your tenants change out, in which you'll get that increase to market regardless with the new advertising fees.
So recycling the tenants isn't a bad thing. and being strategic as well with the timing of when your leases expire. Like if you're leaving your leases expire into a period, you know, you could let it settle for a 6-month lease, or you could do it for an 8-month lease or a 7-month lease. Like,
Yeah, correct.
if your property is going to be vacant before Christmas in Sydney, it's not really the best time to be finding a tenant at Christmas. But if you're in the Queensland market, that's a good time for people to be pushing their rents up at that period of time and expiring their leases. So I think being strategic and planning for all of your tenancies when they expire is very important as well.
Yeah, I think we only had 7 leases that expired in December this time around, and we've currently got 9 properties for lease at this stage. So it's the time of year where you'd like to have continuity on your rental, that you want to know that it's going to be leased out over this period where no one's wanting to move for the short term. February it starts again when people want to move for schooling and things like that. But at this time of year, yes, we would look at a 6-month lease, which would take you through to May. Then we may do an 8-month lease to get you through to January the following year.
Yeah, thanks, Chris. This one is a very big question. I'm looking at the amount of time and the questions that we've got here. I could literally do a full webinar just on this one. So I might leave this one for another day. This one here is, how can we fully retire in 5 years? We've got investors that have been able to, that's a full map session, that's a full strategy session. That's actually what I'm going to do for this one is, how can we fully retire in 5 years? I'm going to give the instructions of getting Gemma, who's on here tonight. This is from Adele. There's a position here with exactly the situation of where this person's at. Get the details from Carolyn and have just a chat, a phone chat about this, because this would be like a half an hour just on its own, and I don't want to, you know, chop it up and not give it its value that it needs. And I think it could be something we could actually do a whole webinar series on. The next one here is, what are my thoughts on rooming houses and NDIS for high cash flow? What is high cash flow? Everyone's selling these NDIS things. They're all selling properties that are overvalued. They're not worth what they're paying for them. So I'm not a fan. I don't have any rooming houses. I don't have any NDIS. If I'm going to have something like that, I will have a motel. I'll have a specialized type of building for that. NDIS, it's not something for me. And rooming houses, you're dealing with people with $100 per week, $200 per week, $300 per week. If the house is worth, if there's a unit that's worth, I feel like someone is near me with a recording of what I've got, which is recording. So if someone's playing this around my office or in another room, if we can turn the volume down, because I can hear reverberation through this, please, thank you. But with NDIS sort of providers, I think that it's very oversold. People used to sell granny flats, people used to sell dual key investments, holiday apartments, stuff like that. You're paying a massive premium. It's a way for people to sell off over pumped up properties. Not something I invest in either of those type of properties. And I think the value of that asset gets frowned upon from the bank, from a lending perspective. And when it comes to resale, it's a very specialized market. So you're cutting out 95% of the market because they're not going to be wanting to buy that type of asset, would be my thoughts on it. So anyone got any further comments on it?
I think also the way in which the banks view the rent, Rose might be able to share. I think they normalize the rent, because NDIS rents can be much higher than normal commercial rent. So if you're getting $60,000 for a property in Glenwood, but the normal rents are 40, then they'll give you 40 in terms of your financing obligations.
Same as NRES as well.
NRES. Cool. Next question here. Is it possible to obtain finance for the property development based on the potential profit only, as the current debt to income ratio is too high?
Well, when it comes to development, DTI is not part of the equation, right? This is a non-NCCP deal. When you do development, definitely you must have a lot of cash, because the valuation, it's either based by hard costs or the realized gross GRV, gross realization value. Now, when you see when you have that line valuation, they value the property based on the whole. If you have a 30 units, when you do line valuation, they value that as a whole. But when you do the gross realization value, they will value it as per what the value of the units, right? Now, that can be determined by the quantity surveyor. Now, if you sell, most of the development loans, they ask you to have a pre-sale. Now, when you do pre-sale, say for example, 50% is pre-sold, that means you have that residual tax. When you do residual tax, they have to look at obviously profit is taken into consideration as per what the equities, the quantity surveyor was saying in the report, but to base the servicing of the residual stocks, which is the leftover, the banks sometimes look at how you're going to market this property. There's a lot of things that goes on, but of course they have to consider the profit or the income based on the residual stock to service that loan. So when it comes to, I'm not sure what the potential profit. You can't really borrow on development just based on the profit only. Of course, you have to put a capital to it's a lower LVR. It could be 65, depends on if it is based on the hard cost. Hard cost can be like at 80% or 75%, based on if it is a gross realization value, it will be a lower LVR. So development is a very broad topic. So we have to, I'm just touching the bird's eye view.
So reach out to Rose or to the team at Zinger is probably the most important thing. There is so many questions coming through. Keep your questions, all the community, keep asking your questions. We will do a follow-up video on this. We'll put it together, we'll do a follow-up one, but we want to get through the slides tonight, but keep your questions coming through. Here's a question. Is there a specific number of properties or dollar amount of value that you reach before you start looking at higher yielding properties, such as blocks of units and commercial property? I actually sent a message a few up, which is from a lady called Nicole. It says, what is after a foundation property portfolio, which was something I talked about beforehand. I think that it's important to build a foundation property portfolio to start off with, which is 10, 12, 8, sort of properties. So I'd say 10 is a nice round number. Once you've got the first 10 properties and you've got 10 hooks in the ocean, you're catching equity, cash flow, you've got liquidity, because you could sell one of those 10 properties off if you got stuck or if you needed to open up for some capital to come in. Once you've got that position, then it's a point when you go, okay, I've got the foundation set. That's just going to look after itself. Now I can start being more creative. I could add in a block of units. I remember buying a motel, one of the first motels that I bought like 10 years ago. No one could go and afford to buy it, right? The market wouldn't be able to afford it. But at the time, I went and pulled equity out of like 10 properties that I had that were like ones out in Mount Druitt and stuff. 100 grand, 150 grand equity out. That enabled me to go buy that property cash outright unencumbered. But if I didn't have the foundation properties, I wouldn't have been able to do that deal. And it's important to lay the foundations first. So when to start, I wouldn't say it's at a point of cash flow. I think it's at a point of risk, and you need to ascertain risk in your journey. And risk comes in all different formats, and minimizing that risk is crucial. And I think it's important to look at the amount of properties, because then you've got 10 properties, you've got 10 sets of rents. You've got 10 properties, you've got 10 opportunities to get equity out. You've got 10 opportunities for growth, 10 opportunities of things that you can sell in case something doesn't go to plan. So yeah, I think it's very important to start looking at the part beyond the foundation portfolio once you've hit that, and that could be the blocks of units, commercial properties, development, land subdivisions, building, realizing that cash flow to be able to live the life that you want on your terms. Here's a question for Chris. Do you have a proactive property maintenance program or reactive maintenance as requested by the property management? That's an interesting question. I'll leave it over to you, Chris.
Thank you. We talked about routine inspections before, once we take on properties and how we go about enhancing the value of them. So on any routine inspection that is completed, of course, you're looking for visual maintenance that presents. We also look at what I like to consider as the short-term maintenance that is required, things that we can see that will need to be looked at within a short period of time, either 3 or 6 months. We then also look at trying to recommend what would be a good capital expense to enhance the value of the property so that we can look at revenue extraction there for the owner. Then we look at the long-term maintenance, and again, this is something that is governed by depreciation levels. If the carpet has got a lifespan of 8 years, if we know that it's been 6 or 7 years since it's been carpeted, we will suggest to the owner they start putting some money on hold for the carpet for when that tenant turns over the next time. Conversely, with the paint, the appliances, kitchens and bathrooms, they're the ones that have got the biggest increase in value potential. So it's a plan for each individual property, depending on the age and the condition, and also if it's a strata property or if it's a standalone property. Again, the external of a strata property, we're governed, we can't touch it, we can't do anything with it. So looking at putting fly screens on needs permission. Looking at putting extractor fans vented to the external, we need permission. There's too many governing factors when it comes to the strata management. But from our perspective, yes, we like to do short, medium and long term to try and make the property more attractive, not one to the tenant, but two to the owner. So if they need to extract funds out of it, they can.
Fantastic. Thanks, Chris. I think it's very important that, these are your assets. And yesterday on a Facebook Live, I was talking to Andrew from the team, and she was talking about when she does routine inspections, she actually goes and takes photos of the owner's assets, which the owner's asset is their oven, their sink, the toilet, the vanity unit, all those sort of things, the kitchen cupboards, the washing machine, the dryer. And I don't think any real estate agent out there really talks about the items around the person's property as their assets, and that is the assets. That's a fixed asset. If you're looking at it from a business perspective, any business has assets, which are the tables, the chairs, the computers, and all that sort of stuff. I think it's important to update everyone on a regular basis based upon that. So thanks for that. This question is a very quick one. Would having a longer term fixed mortgages like the USA be better off for investors, or does that make it harder to release equity? Rose, do you want to answer this one very quickly, or?
Yeah, I will answer. Definitely, fixed rate is difficult to release equity because it is fixed. We don't want to get if we refinance, you could be exposed to a exit fees. But the same token, it's not that it's all bad. You can also just top up the loan within the same lender. But the problem is, if you have problem servicing on that lender, then you get stuck. You can't harvest the equity. So releasing equity under fixed rate is a bit of a downer. But so, the most I could do for fixed rate, I will not go beyond three-year fix.
So in the US, they make mortgage terms like 30-year fixed rate, 40-year fixed rate. They actually fix it for the life of the loan, and the mortgage is attached to the actual property. It's not attached to you as a person. I think that leads us over to the next question from Ali, and it says here, if the banks blow up, is there a possibility of them claiming every asset that has a mortgage linked to it? So this question, in short, I would imagine the saying blown up the bank wouldn't mean that someone's blown up the bank, but literally the business imploding on itself. just like it did in the GFC. So if the bank was to go bankrupt, what would happen? The fun thing is that if you had a loan with a bank and the bank went insolvent, which most banks are insolvent, they're all broke anyway, but that's a story for a different day, and you have a mortgage attached to it, the mortgage is actually the asset of the bank. So when the new bank and the new lender comes in, the loan is valuable. So they don't just call that loan back because that is the value of it. So that loan is not worth anything. The bank's not in the business of selling off properties. They're not a real estate office. They're not a property owner. They're not a property developer. The banks are in the business. If the banks blew up and they took your assets, then there would be an issue in the financial market, and it means that your asset would go down in value. The most important thing that people don't realize with the bank is that the asset, being the property, is one part of the bank's asset, but you, that's taken out a mortgage, which is a 30-year contract, is you're selling 30 years of your life to that bank. You are, well, there's the camera, you are the actual asset to the bank. So if the bank was to go broke and blow up, then the bank would become very valuable for someone to come in and buy those loan books. So yeah, I look at, if the banks were to blow up, it would not be of an issue. You know, it is what it is. You just have a different bank. And I actually realized recently the banks have changed their name and the different owners of them, which is quite an interesting story for another day once again. Here's a question for Ridhwan, which is, what are the biggest property tax deductions you can claim? Ridhwan?
Yeah, look, I mean, it's one of those things where you property tax deductions, large or not, they are subject to a change. B, it might not necessarily be good, right? So, you know, the largest and most obvious one is depreciation. Typically speaking, you get two arms of depreciation which you're able to claim, which is the, you know, the soft finishings and fittings, and then you've got your harder stuff, which is, you know, roof slab, you know, inside the walls. So those two arms are the ones that you can generally claim. There's obviously interest, which is a very large one, generally speaking. A lot of clients prepay interest as well, so there's quite a significant claim in terms of property for interest deductions against the property there. Strata is another large one. In terms of strategic property deductions, generally speaking, it's prepayments, it's depreciation. In some instances, depending on the nature of the claim, there can be larger claims with reference to, you know, repairs, damage, which is claimed. And then sometimes you have certain items of levies, which are quite large as well. You know, in terms of what are the biggest property tax deductions you can claim, you have to weigh that up with, do you want to be claiming large property tax deductions? Because if you do, and they're cash related deductions, then obviously they're costing you a lot of money. So the best type of deductions are non-cash deductions, which is depreciation and the like, but also depreciation is a double-edged sword. When you sell, you must add it back, right? You end up adding it back if you've held it for more than 1 year at a different rate, because you obviously get a capital gains deduction. But in answer to the direct question, it'd be interest and depreciation.
Thanks, Ridhwan. Next question here is for Stephen. How often should you have your will reviewed and amended?
Every time your circumstances change. So if you get married, if you get divorced, if you have kids, if you acquire new assets, yeah.
Okay, awesome. So on a regular basis, so if someone's buying a new property, yeah, anything's changing, speak to your lawyer to get the will updated. Here's a question here. Is it better for my partner and I to buy our investment properties together or on our own? And I think this one I could answer on behalf of everyone, but I'll start it. And if anyone's got anything else to add into it, then add into it. Couple of things. When it comes to finance, if you were to finance a property, let's say if you're a boyfriend and a girlfriend, two mates, let's say, I don't know, me and Ridhwan or me and Steve or someone here on the chat would go halves in a property. If I can borrow $500,000 and you can borrow $500,000, we can buy $500,000 worth of property each. If we go halves in the property, then most banks would take that loan as jointly and severably liable. It's not that we're both now liable for only $250,000 of that portion. So in essence, you know, we could collectively borrow a lot more money from that perspective. Secondly, if you are with someone, you know, you need to plan out, are you married? Are you just in a de facto relationship? Do you see this going long term? What happens if one of you separate from the other one? Is one of you planning to work for the next 20 years and one of you is working for the next 5 years until you have kids, or 3 years until you have kids, or whenever it is? How would it look like if the spouse was not working at that point? Because then you'd have maybe some tax credits and certain things. So it's important to make sure that two people are on the same page and that they have very clear goals. And some people say, well, my partner isn't on board with it, or whatever the case is. That's a very big problem. You need to get them on board and involve them and work out ways of how to involve them. Generally, I've found the best ways over the years from people's positions is making sure that the other person gets involved and has clarity about why they're investing to start off with and how it's going to improve their life and what sort of things will change with their life from doing that. Yeah, I've always thought it's good to buy things separate, especially when, like, if you've got yourself and a sibling or whatever. That's a very bad position if you're doing it with a sibling, because, you know, you might both be 25-year-old today, or 27 and 26, or whatever the case may be, and then in 5 years' time, one's married with kids, the other's on continuing tours, and it's going to be a very different sort of scenario at that point. Anyone else got any further input on this question?
You're talking about partners being on the same page. I just think I've seen a lot of people not being able to fulfill their potential. And I actually got very, very stressed just because they hadn't conveyed to their partner exactly what it was they were doing, who we were, who Nathan Birch is, telling us to do all these things about money, and as a result have then just not done anything. So again, it's do something, but I think it's take a lot of time to prepare that you and your partner are on the same page. And even if they say they're not interested and they're going to let you do it all, they suddenly become very interested when they see a lot of money leaving the bank account. So having that conversation is it's invaluable.
And having the advisors, the right advisors on your team, because you know, quite often I see there's an Eminem song where it's just you're plain old Marshall to me, right? Like, you could be the husband, you could be the wife, you could be the girlfriend, you could be the boyfriend, whatever it is in the scenario of the relationship. Is that you could, being plain old Marshall, right? You're just that person that's the silly partner or whatever the case may be. Suddenly, why are you an expert in finance and investing, all those sorts of things? So it's important that that partner understands, you know, what your team is doing and be able to hear it from other experts who are on your team. Otherwise, you're just a voice and all those other people aren't being heard. So it's important to engage with your partner on that front. Here's another question. Will the rising insurance premium in North Queensland put people off from buying up there? I'm seeing it's one of the hottest markets up there. North Queensland used to have a much higher insurance premium. If you look at places like Cairns and stuff like that, Cairns used to be much higher than what it is at the moment. You know, it goes through waves and cycles. Who is insuring up there? Who is funding it? You know, it depends. The more lenders, the more insurers that are in the market, the more competitive it becomes. And I remember going back in early, like 2010 or so, there was a cycle in Yahtzee and a few things like that that occurred, which pushed up insurances so high that most of the strata units up there had strata fees of like 10 grand a year for strata, and now it's down to like 2 grand a year and stuff like that, which is very much more in line. So I can see, you know, it could put some people off, but I don't think it's having an impact over the whole market. And if it does, if insurance policies rise so high, it makes it more competitive for more people to step in the market, so to make more money. And yeah, I think it'll be neutralising itself. Here's a question for maybe Ridhwan and Rose. Should all the rents come into one account or keep the rents in separate accounts for each mortgage to be drawn down upon?
It's really just the client's preference anyway, but to keep so many accounts, isn't that, it's very tedious. But I think if you can put all the rent in one account and then direct debit from that, I mean, I guess managing it is more easier, I guess. I don't know, Ridhwan, for accounting purposes, what do you think?
Again, from an accounting point of view, so long as generally speaking, we will run off the agent reports and understand what their actual properties earned as opposed to what's gone in the bank. We do often look at that. We get this question quite often. It depends how particular you are, what level of detail that you'd like to maintain, how strict you are with regard to segregation of accounts, for example. But small wins are something that people often look for as well, and small consistent wins are often larger gains at the end. So a lot of people have all their rents going against their home, right? So they're having as much money offsetting their home as possible throughout the year, even though it's a small amount, it's whatever, $400 a week or whatever it might be, it still makes a difference. And so they pay all their expenses out of there. So the maximum amount of money that can be offsetting their home is where they keep it. So again, it is client's preference. If you do have the opportunity to have everything segregated really nice and clean and clear, and you don't need to use that offset, then that's ideally really good, and that helps from an audit point of view, an audit risk point of view, because if everything's going into one account, then the tax office might find it harder to be able to delineate what's for what. So you should be in a position to at least keep good record keeping if you are going to offset your home with all the additional rents.
From an investor's point of view, I was finding that as I was taking equity out and then going to a different bank and whatnot, I had about 16 bank accounts, and I didn't know where any repayments were coming from, and I had to try and park. Rose, you're laughing, it was awful. I was so stressed. I had to park money in like all these different accounts and realized I didn't have enough money to park that amount of money in every account. So one thing I wish I'd known would be, as I'm releasing equity, to close off ones that I don't need anymore. And then what I've done is I've actually put my rents to go into one account and my repayments come out of the same account. So then my property manager never needs to change it. And when I'm releasing equity or setting up a new loan, I nominate that account. So at least then, as long as there's 10 grand parked there, then I'm never going to miss a mortgage repayment. That's all I was worried about, because obviously it would affect servicing. But just along the way, at the beginning, it's like, just do whatever you got to do. But it gets very messy if you're not closing things off as and when you don't need them anymore.
I think it's important to make sure that you don't have all your rents coming out of your transactional account or your mortgage repayments, because you'll suddenly go to the shops and put something in your card and it declines because you've had all your mortgages come out on that day, or some insurance policies have set account for the bulk of them, would be my thought. Next question here, we're almost at the end. This is a question for Chris. Do you review each monthly rental income statement for each property, or do you trust your property manager? I don't know if it's a question for all of us, or if it's Chris. Chris is the property manager. I'm thinking for myself as an investor, I occasionally look. I've got to trust my property managers to do their job. I do look, but I don't count every single little cent on my portfolio. I look at it and go, okay, cool, yep, that all looks fine. Hey, this one here is behind in arrears a lot. This one here is in a position, but I do trust my property managers. Otherwise, why would I have my property managers for? I'd have to change them. So, Chris?
Yeah, I believe all real estate agencies that have property management arms to them, they're very high turnover of staff, unfortunately. So, yeah, I believe every investment property needs to have a rental statement every month that is checked by the owner. Everyone is human, they do make mistakes. When we sign up a management agreement, we have a pre-authorized amount that we can spend on the owner's behalf for emergency bits and pieces like plumbing, electrical, maintenance that is required, without having to go to them to say, hey, can we change that washer, or can we replace that light switch? That's not the domain of a property investor. They don't need to know those little bits of, that we'll call them, that happen. They don't need to know that, but they need to know it on their statement when they see the invoice come out. Oh, what's that? $55 for electrical work. I wasn't told about that, but the invoice is there for them to see, and they can understand what it is, and they've already been made aware that it has happened. So yeah, I think accounts people are human, administrators are human. There are things in the program that can duplicate for whatever reason. So I would highly recommend that if you've got properties, that you do look at your statements. And one of the questions before was, do I have access to my online portal? I'd utilise that and just scan your statements as they come out. You can see where the rent is at, and you can see where your expenses are at the same time.
I think it'd be worth adding that I don't think it's healthy for any customer, client of any business to have unconscious buyers. You really need to do some due diligence in the purchase all the way to the end. But I think it's worth mentioning that even using a buyer's agency, there's always risk with everything that we do and invest in, and we can heavily mitigate risk, but none of us here can eliminate any risk, apart from maybe the solicitor. He's definitely going to be able to eliminate risks, but as a general rule, we can't completely eliminate it by the nature of the game. It's definitely going to be have an element there. So you have to be really conscious of what is happening and understand it. So I always check my statement and bombard people with questions that I don't understand.
Yeah, I guess from that perspective, we're dealing with hundreds and hundreds of properties. We're dealing with hundreds and thousands of invoices for properties. So if something isn't coded right, if something isn't inputted right, they go through the whole month end or mid-month run, and it may not get picked up. So it is important that you are diligent and you look after your own finances, or just keep an eye on them anyway. Yeah.
It's just like running a business, guys. If you don't have visibility over your business, you don't have clarity over it, things go by the wayside. So it's very important to do so. I look at mine quite regularly, but not every single month. Otherwise, there's heaps of them. I identify. I know when there's an issue because I can see that there's a kink in the hose at some point. Like as you get to build your portfolio out, you know, hey, hang on a second, there's not the right amount of revenue. And I actually did that last month. I called out our trust account, and I wanted to get a report as to why, you know, funds went into a certain perspective, certain position, not into where they normally go to. And errors do happen, and it's important to be across. But you do need to have that trust in your property manager as well. So thanks for answering that, Chris. We've got our last question here for the night, and then I've got so many questions from you guys from the community tonight, so keep your questions coming through. I'm not going to answer the questions and do the question and answer tonight, but I'm going to make another set of videos. I might hop online with, you know, whoever would be best to answer them and do a run-up video, because we've been here for 3 hours tonight, and you know, I want to make sure that we're, you know, all respect everyone else's time out there. So last question of the night is, where can you buy a property for $200,000? And the question came from the extra part of the question from the community. Said here, I saw a video that you said you buy a $200,000 property and then another one in the same year, rent it out for $300 a week, and you said to this for 5 years and you'll have 10 properties. But how am I meant to save 50 grand a year out of the 300 grand you have to pay, out of the $300 you have to pay the real estate agent, strata fees, insurance, and then of course the mortgage? You are doing interest only loans. So I want to do a reference to a different video, because I actually had a different question here from in the messages just recently from this Nicole in the chat here. It said here, I'll rephrase my previous question. How many properties would you need to own before you live off the property's cash flow? I did a video, like it's a very in-depth video on this, on building the property strategy, a webinar that I did maybe 2 or 3 months ago, which you can just chat with the team, speak to Gemma. She will get that video and send it over to you, send an email over to the team at admin@binvested.com.au to send you that video. But I broke it down very clearly on how to buy the property. If you're buying a property for 200 grand and it's worth 250 grand, you buy it for 200, you get a loan you put down a $40,000 deposit and about $10,000 for legals, stamp duty, that sort of stuff. You buy the property for 200 grand, get a loan on it for $160,000. 160 grand, let's just say that we go 5% interest on that. 5% interest on 160 grand property is $8,000 a year. $8,000 a year divided by 52 weeks in the year is about $160 per week. So if you're buying a property for 200 grand, you've got a 160 grand loan, you're paying about $160 a week in interest. If you're getting $300 per week, you're now getting about $140 left over. That $140 would cover the strata, the council, the insurance, all those sort of real estate fees, all that sort of stuff. If it's got an extra $50, it goes in your pocket. If it takes out $20 on top, well, then you cover that $20. But in instance, where do you buy a property for $200,000? Rose, Ridhwan, and Steve, specifically Stephen, he has seen me send 15,000 properties in the last 10 years of 12 years, 14 years of business, hundreds of properties for myself that have been in the 200 grand category. I've been doing it in 2006, 2007, 2008, 2010, 2015, 2020, 2022. We're still buying properties all around the country, whether it be in large regional areas, whether it be in capital cities. I did a property in Brisbane today. I did a property in Brisbane yesterday. Gemma, how much was that property in Brisbane yesterday? 100 and what?
I don't know which one that one is.
$133,000. The modern one.
Oh no, yeah, I do. Yeah.
And,
no, definitely.
Yeah, and how old was that property? I don't know if you looked at it. I'll put someone on it.
Yeah, it wasn't my client that was on it, but
Okay.
I know whose client it was.
In Brisbane, I've got a 2-bedroom townhouse today, 225 grand. I'm sending it out to some clients tonight. In Perth, I'm picking up property for 150, 170, 180, 190 grand. Perth. So you can still buy in capital cities for under $200,000. I did a new investor yesterday I spoke to. He's buying 2 properties today, 170 and 149. These are properties in Queensland with the rental sort of prices around the $300, $320 per week. So definitely out there. All states have them. It is becoming harder and harder and more difficult to buy properties under 200,000, and that's just happening because of inflation. I used to be able to find properties for 20,000. Steve, how many properties I sent you over these just for myself? Just random question, right? Which would be under $50,000 for me that I bought.
For you?
Yeah.
I don't know, like heaps actually. There's plenty. I mean, as a percentage of all the ones that you buy, not a high percentage, but there's plenty.
Yeah, like I reckon, like last year I did 3 lands. I did, yeah, like I reckon I've done 40 to 50 properties that you've done for me, which have been under $50,000 over the last, to get that, it's getting more difficult to find those type of properties. Some of those properties are the ones that I've bought with the purpose of buying them for 10, 15, 20 grand and then selling them for 100 grand. And those times are here, and I'm offloading a few of those things at the moment. But, the 200 grand point is sort of now the new entry level. And all the properties, probably 50% of the properties that we've bought, maybe 70% of the properties that we've bought for our investors have all been under that $200,000 price point when they've bought them. And then they sell them for, if they go to sell them, 500 grand, 450, those sort of things as well. So definitely still possible to buy them. I can't give suburb by suburb and location because that's our business, and we help people locate and negotiate those deals. I do those deals myself, and the team obviously make me look very great because I can't do everything, and it's important we have the professionals around us to be able to action and implement those strategies for myself and you guys being the investors. So hopefully that has answered a lot of your questions. I would normally have this question and answers here, which I'd ask the community, but I reckon I've got like another 2 hours worth of questions here to answer for you guys. So I'm going to take those questions. Carolyn from my team is going to chop them up. We'll make some more videos out of that. We will get them answered, so keep an eye out to the YouTube, the Facebook, the Instagram channels, and we'll put that information out there for you shortly. If you need help on your journey and planning for your 2023, reach out to the team. You can book in a free discovery session with Gemma or the rest of the team. Gemma's got like a half dozen colleagues around her which do similar sort of job as Gemma. Book in a free discovery session, which is binvested.com.au/discovery session, or you can contact us if you've got any questions to get in contact with Stephen for a will, or Rose for finance, or Ridhwan for getting some tax advice, or Chris to look at what he can do to increase that rental fee. send us an email at admin@binvested.com.au, and my team will put you in contact with the right department to make sure you're on track with your goals to get you to where you want to be. And on that note, it is a 3-hour webinar. We are wrapping up at 3 hours. Thanks a lot for tuning in. Thanks a lot for being a part of the community in 2022. This is our last webinar for this year. So I wish everyone had a good Christmas, or if you don't celebrate Christmas, have a good holiday. Make sure that you take this time to plan for what your 2023 looks like, what you want from it, and make sure that you take action in 2023 that's in line with what you want to be and who you want to be, to make sure. So thanks for watching, and we'll catch up soon, and I'll see you in the next year. Thanks everyone as well.
Thanks all.
Thanks to my team of experts for spending your Wednesday night with us. So yeah, we'll catch up shortly.
All right. Thanks.
Thank you.
Good night,
Thank
guys.
you.
Thanks.